Yo, what is up? What's good for everyone watching this on the replay? I hope you're having a great day. The market is having a surprisingly good day today as well. I'll start this off by doing a quick portfolio update, then we'll get into all of the stocks that you guys want me to analyze in the chat. So, yeah, we'll start with my Weeble portfolio here. It's having a pretty good day actually because of AMD. And that's what I decided to trim. I did just trim one more share of AMD. There's the little sell order right there. I sold one share of AMD at okay, well I guess it won't let me view that. Well, I sold a share of AMD today for a little bit of profit. I mean, I'm up 340% on AMD. I couldn't help it. And I'm looking for stocks to buy right now, but I've really looked around. There's really not too many deals out there in the market. So I do think right now is a good time and it's okay to just chill on some cash right now because normally I like to just spend all my cash instantly, but right now I think it's going to pay off to be a little bit disciplined with some cash on hand. But yeah, we're up 3.94% on the day, mainly led by AMD. That's up 7.6% to a new all-time high. Reddit is up 10% on the day. Futu's up 4. Dave is up 5.6. Uber, we were just talking about this one a bunch last night. Uber's up 6%. AppLovin 6. Robinhood 6. Ouster 16. I mean, I just can't believe it. And only a few of our stocks are down, like Sprouts Farmers Market, AbbVie. And let me show you the QQQ on the day. Hey, what's up, Monkey D. Luffy, Spray Cheese? Hope everyone's having a good Monday. Look at the Qs. You must be having a good day. The QQQ is up 3.1% on the day. The S&P 500 is up 2% on the day. And oil is down 5. You know, whenever oil is down, that means that leaves more money for consumers to spend on discretionary stuff instead of paying more to go to point A to point B by paying more in oil. So anyway, here's my Robinhood portfolio. Today we're up 2.7%. Year to date, we are up 2.26%. And over the past year, or since 1 year ago exactly, we are up 18%. And this is my lifetime percent return on every stock. So Google has been our best performer. We bought this one pretty much like exactly a year ago. And since 1 year ago exactly, Google is up 109%. We're up 127%. It's not like I bought the dip on them. They just have done so well the past year because they're a big AI beneficiary. Yeah, so my largest holdings at the top and then my smallest holdings are at the bottom. And yeah, just today, Meta's up 5.5, Carlisle's up 4, Google's up 3. So yeah, that's my dividend only portfolio. It's kind of simple. I just got 7 stocks in here and I try to keep it concentrated. And then I also have a Roth IRA. We started this pretty much exactly 1 year ago. And since we started this 1 year ago, we're up 0.5%. So we really have not done better than the market. But these are the 4 stocks that we own in here. And the main reason we've underperformed is because of HCA. We're down $420 on this stock. And all time, we're up $37, but that's really offset a lot of our gains, unfortunately. But that's all right. I'm still bullish on HCA Healthcare. So yeah, those were my 2 Robinhood stock portfolios. Congrats. Yeah, QQQ is up 3.2% on the day. Our Webull account's up 3.9. And finally, last portfolio, then we'll analyze y'all stocks in the chat here. We got our Moo portfolio in the top left. This is called our buy and never sell portfolio, where once we buy a stock in here, we're legit never allowed to trim a share or sell a share. So it's been tempting sometimes, like Powell Industries, we're up, over 1,000% on them. Comfort Systems, we're up, 19 grand on this company. We're up just today another $1,100 just on that stock today. It's been tempting, but I'm literally never allowed to trim or sell. It's like an experiment I started. So year to date in this account, we're actually up 76%. And it's mainly because of that strategy where once we buy a stock in here, we're legit never allowed to sell it. And unfortunately for me, all of my stocks are green. And here's my portfolio 1 year ago. This is crazy. So we just saw Comfort Systems and Powell Industries. Look at the top here. I used to be down 16% on Comfort Systems. I was only up like 110% on Powell. I was down on Amazon, just barely green on Amphenol stock. And now, my portfolio looks entirely different. That was like 1 year ago in 2 months. It was last April during the tariff dip. And well, here's our portfolio today. So anyway, I saw someone ask, Duolingo, and Joseph said Sprouts Farmers Market. What's up? Yeah, let's do Sprouts Farmers Market. Definitely an update in the market this morning. Lots of green. Yes, sir. Hey, what's up, Tom? Good to see you. So let's look at Sprouts Farmers Market and then we'll look at Duolingo stock. So I am down bad on this stock. It's one that I do own in this portfolio. Full transparency, I am down 34% on my Sprouts Farmers Market position. I suppose Sprouts Farmers Market is underperforming other grocery stores like Amazon, Whole Foods, Walmart is because they lack an online presence. I think Sprouts Farmers Market is just kind of being out innovated by Whole Foods because anything you can get at Sprouts Farmers Market, you can get at Whole Foods, and Whole Foods is owned by Amazon, and Amazon will deliver it for you. So that might be what's hurting this stock. But I still love this one. They traded at 15 forward PE or 15 times next year's net income. And these grocery stores are really a net margin game. Historically, very low margin. This stock has the best margins I've ever seen for a grocery store. Kroger is lucky to have a 2% margin. Costco's lucky to have a 3%. Walmart like a 4. This company sometimes gets like a 5 to 6 to 8% net margin. So I love the margins on this company. But most importantly, I like the share buyback. So as we can see, the net income declined by 9% year over year. So the net income's down by 9, but the net income per share is only down by 5.5. How did the net income per share fall less? Well, it's because of the share buybacks. It acted as a nice little buffer because they bought back like 3 to 4% of the entire company in the past year. So anyway, that's the one thing. If you like Sprouts Farmers Market, you'd probably love Amazon because Amazon can deliver it to you because they bought Whole Foods, the grocery store. And Amazon, of course, owns a bunch of other stuff. But this is I like Sprouts Farmers Market because it's like a healthy grocery store. A lot of people, when they go to Sprouts Farmers, are looking for healthier stuff. And usually these healthier products have a higher margin than, like a Kroger something. I don't know. Anyway, that was Sprouts Farmers Market. So let's check out Duolingo right here. This one I sadly don't have anything good to say about. So we've all probably heard of Duolingo before. You have to pay them a subscription to learn a new language. So if you got to learn Spanish or something, you pay for Duolingo subscription to learn it. The bad news is, as we can see, this stock is on a massive downtrend. From literally 1 year ago exactly on the left, the stock was $520. Now it's 127. So you think the valuation's got to be cheap? It's not. They actually still trade at 42 times next year's net income. So not even like trailing 12 months net income. They trade at 42 times next year's net income. So that starts to make Duolingo look very expensive. And the other thing is the AI thesis on Duolingo. They're saying in 10 years from now, will we even need to learn a new language? Maybe AI will make live language translation technology so good that you don't need to learn a new language unless you're forced to for school or something. Like in your Meta Ray-Ban glasses, maybe it'll translate the technology so good. And also, another reason the stock fell 10% on one day was because ChatGPT, which owns OpenAI, announced they're made a language learning app that's completely free. So that's kind of the AI thesis kind of hurting Duolingo right now. So and at that forward PE, it's kind of tough to buy at a 43 times next year's net income, I will say. Yeah, we'll look at Microsoft after this. What's up, Matt? And I see Micron. Yeah, we'll look at Micron. Hey, what's up, Narc? What's up, man? Happy trading. Yes, sir. So here's Johnson and Johnson. It's actually a really good pharmaceutical company. They're growing their oncology business like crazy after their Shockwave acquisition, where they like literally use shockwaves to like vibrations to like remove certain like bacteria and cancers or something. But anyway, Morningstar says they're actually overvalued. Wow. While the product launches in oncology and immunology help offset near-term revenue headwinds, long-term patent exposures and intensifying competition warrant caution. It is tough to be bearish though. I mean, look at this forward PE. It trades at a 23. So they're only trading at 23 times next year's net income. And Johnson & Johnson's a great dividend payer. It's like such a blue chip stock, but if you buy a share of Johnson & Johnson right now, you're getting 2.2% of your money back just in a dividend every year, not including the stock price appreciation. Normally, they give you like 4 to 5% stock price appreciation on top of the 2.2% dividend yield. So you should get like 6 to 7% of your money back a year with Johnson & Johnson. And look at how they've beaten on expectations the past 3 quarters in a row. The orange line's what the analysts predict. The blue line's what they actually report. And if they keep beating on earnings like this, I mean, I wonder... what are they going to do the next couple of quarters? So, yeah, they could pay off all their debt, I think, in less than 1 or 2 years of free cash flow. So, yeah, Johnson & Johnson I really like, but maybe wait for a bit of a pullback. But I like the dividend. Yeah. I own AbbVie, ABBV. Okay, so oh yeah, let's do Microsoft right here. So Microsoft, I just bought this one as well. It's one of my most recent purchases here. Here are all my most recent purchases in their exact order. In Microsoft, I just bought 3 shares of this company. Guess my Wi-Fi is a little slow right now. Doesn't want to. Okay, there we go. So yeah, there's my little buy order right there. And I'm actually looking to buy more shares. I don't have. I want to own more quantity of shares. I only got 3 shares of Microsoft. I eventually want like 5 shares. But I'll wait for another pullback. But yeah, check this out. The past week, they're on this big downtrend. And right now, Microsoft, in my opinion, is one of the best stocks to buy, not financial advice. The reason they're falling, though, is because Microsoft is the world's #1 software company. Think of Excel, spreadsheet, Word, PowerPoint. Just that software business for Microsoft does 120 billion of annual revenue, literally just the software business. Then they have this cloud business, the Azure cloud business that also does over 100 billion of annual revenue a year. But anyway, the reason Microsoft's falling is because they're the #1 software company. But anyway, I'm a believer that, AI is going to help out their software business, and Microsoft is hedged. Out of all the software stocks that exist, Microsoft is really hedged because they literally own 20 or like 19% of OpenAI. So if ChatGPT and OpenAI really takes over software, Microsoft is hedged as an owner of ChatGPT. And if AI really starts to get huge, their cloud business will get bigger. AI uses a lot of cloud, and as the second largest cloud provider, right behind AWS by market share, I think Amazon or Microsoft is great. They also own, Activision Blizzard. They own Xbox. They own Minecraft. And here's the net income forecast. They're supposed to make 31 bill of net income next quarter, 34 billion the quarter after. They're literally a money printer, and it's hard to be bearish because Microsoft's literally at a 21 forward PE or 21 times next year's net income. I mean, just ridiculous. So, that's ridiculously cheap. Microsoft Xbox division plans major layoffs and budget cuts amid revenue decline and hardware component crisis. So Nintendo's seeing the same issue, and the iPhones are as well. The memory shortage is really crushing Xbox margins, PS5, Sony's falling, Nintendo Switch. Nintendo stock is falling because of this memory shortage from Micron. And yeah, someone just asked about Micron. Curious if you can compare. Yeah, let's look at B. Let me look at Micron and then we'll look at BMEA, a pharmaceutical company. I got you. So yeah, Micron pretty much at an all-time high today. Wow. We've kind of predicted this because it's hard to be bearish. I mean, most people look at this stock and it's like, okay, is there any upside left? They're at an all-time high. They've literally they've like they've 10x'd from exactly 1 year ago. From exactly 4 quarters ago, they are up 10x. This is your RAM memory shortage and play. And here's the tough part or here's why it's tough to be bearish. When we value them off next year's net income or on a forward PE basis, Micron trades at a 10.9 forward PE, which basically means in English, they only trade at 10.9 times next year's net income. And here's the actual net income forecast from these analysts. Micron's supposed to make 22 bill next quarter and 26 billion the quarter after, which is over 100 billion of net income a year annualized. And they're worth 1.21 billion. So they really are at a 10.9 or 11 times next year's net income. But the thesis is here 2026, 2027, that's going to be peak ever EPS for Micron and SanDisk because, they just sell a commodity, RAM, memory, SSDs, hard drives. And there's, this commodity is being overinflated. All the demand is being driven up by data centers, and there's this huge shortage. So multiple analysts raised Micron price targets, citing tight memory supply through 2028. Ridiculous. Micron identifies storage as overlooked AI bottleneck, predicts supply constraints beyond 2026. Anyway, there's a ton of shortages right now. There's like a CPU shortage that Intel and AMD are benefiting from. There's the memory shortage. So what app using? Oh, hey, what's up, Pluck? I'm actually on a brokerage is where you buy and trade, sell stocks on. I actually have it linked in my profile there, like bio. So yeah, they have a huge backlog. Yeah, absolutely, Edward. So next up, someone wanted me to look at BMEA stock. What is this one? Biomea Fusion. So yeah, you want to be super careful with these small caps. If you look in the top right, they're worth $87 million. That's just such a small, and the stock's at an all-time low. So here's the thing. The whole company is worth $87 million. This is a revenue-less startup. So when we go to revenue right here, or even if we click right here, it says no data because they've never sold anything. It's a startup. They've never sold a product or a service, so they've had no revenue and they just lose money every quarter, 12, 11, 18. So here's the thing. When your whole company is worth 87 million and you lose 12 million, that's more than like 15% of your whole company in just one quarter, not even including all the other quarters before today. So would I buy this stock? No, simply because it's a revenue-less company that loses a good chunk of their market cap every quarter. Hopefully that kind of makes sense. That's kind of how I like to analyze stocks. It's just I don't like revenue-less startup, unprofitable companies. So Pluck said Ouster. So I do own this company. I'm actually a very happy shareholder, and I regret not buying more. I mean, we all have that feeling sometimes. This is my quickest double ever, and too bad I only bought like $50 of the stock. But I bought this stock. There's my buy order. Literally like 3 months ago or 2 months ago. And in literally just 2 months, my Ouster position is up 166%. So this is a LiDAR company. LiDAR right now is being used in autonomous vehicles and drone defense. So they just served, there was some news today. Ouster is expanding their production. They hit like this target and now they're like producing a lot more, okay, where's this news? Yeah, Ouster climbs on expanded benchmark deal to scale their Rev 8 LiDAR output. So yeah, these robo-taxis, these autonomous vehicles on the road use LiDAR, and also they're used in drone defense. They have the world's first colored LiDAR. So yeah. Anyway, by the way, if you're watching this on TikTok, I'm going to have to end the TikTok stream. I don't even know if y'all can see this, but I don't know how this is possible, but my TikTok stream is restricted, is getting taken down because it contains unoriginal or reproduced content. I'm not sure how that's possible, but anyway, if you want to support me, please go to my YT, my YouTube. Just type into YouTube Nathan Robert and you'll find the stream. We're going to be continuing it only there. So that's unfortunate, but I saw some more. I'll look at a few more in the TikTok stream. Someone said SoFi, please. Yeah, let's do SoFi. So yeah, anyway, I'll be streaming on YouTube. Type into YouTube, please, if you want to help a brother out, Nathan Robert. By the way, I saw nothing. I have no course book. I'm just under giving my opinion. But yeah, the stream just got taken down, so the viewers should just spiral to zero. Anyway, I'll be streaming on YouTube only. Type into YouTube, Nathan Robert. Hey, what's up, Brian Paul, Tomboy, Pew Pew, Japan. Good to see everyone. Yeah, we'll check out all. We're looking at every stock in the YouTube stream. If you comment a stock in the YouTube stream, we'll definitely analyze it. So here's SoFi Technologies. This is a stock that I also just bought a share of. It was literally days ago. I bought a share at $15.50. So yeah, that's, oh no way, dude, Brad, thanks for that gift there, the confetti. Dude, if you have a stock you want me to look at, let me know. I greatly appreciate that little gift there on TikTok. Too bad the TikTok stream just got restricted. But anyway, SoFi Technologies, this is one of my favorite growth stocks, and here's why I love this one. And I own this one personally, and I own it for a reason. If we go to their lending business right here, check this out. Their main business is growing extremely fast. It grew 55% year over year. That's the fastest growth rate on the entire screen. So their main business, lending, is up 55%, and the other half of their business, the financial services, is also growing extremely fast. It's up 41%, after grew 101, after grew 85, after grew 244. That is an insane streak of growth. And that's what you want to see. If you're going to, diamond hand a growth company, I don't know why it's on cumulative. Let me go to quarterly. Look at this. You want to make sure the company is growing like crazy, and like literally by the quarter, the revenue hits a new record. So revenue's up 42%, and we don't just want to see companies make revenue, we want to see them make net income and profits. And net income this quarter was $166 million, up 134% year over year. Margins expanded from 9 to 15% net margins. And check out the net income forecast. There's still a lot of EPS growth to come to SoFi. The net income in 2 quarters is supposed to hit 237 million. It's never been close to 237 million before. So when we judge them, since this is a growth company, we really want to judge them off next year's EPS. So when we look at a forward PE, SoFi's only at a 24. That's literally like an S&P 500 multiple, a 24 PE ratio. So yeah, I wish I owned more SoFi shares. I'll share with you my position here. And I'm still up a good chunk on them. But yeah, I got 25 shares of SoFi right now. Is SoFi a buy? SoFi's a decent nibble. You don't want to go all in on SoFi at current prices, but it might be worth nibbling on. So Narc says CRT. I don't know if I can find that stock. You said CRT REIT in Canada for Home Depot. What's the name of that stock? Is it Cross Timberlands Royalty Trust? I don't know about that one because it's a weird ticker symbol. How come stocks are green when Coke and CTRE go red? Oh, that's because those are defensive stocks. So yeah, remember 2 weeks or a week ago when the QQQ was down bad? These stocks were really green, CTRE and stuff. All right. So next up, why do you own so many stocks with only a small amount in them? Yeah, exactly. If I have one big critique, it's that I got way too many holdings for sure. But why do I have some small positions like Netflix right here? Here's how I'm approaching buying stocks right now. In this high volatility market, I want Netflix eventually is like 4% of my portfolio, but I can't make it 4% of my portfolio today. I'm only right now it's only like 0.5% of my portfolio. I'm only going to add more to my Netflix once and only if it falls 5 to 10% more. Then I'll buy more. And if it never does fall more, then GG, I tried and I still own shares, so I don't mind. So what's up, Brian Paul? He says, I'm up a couple percent today. Not bad. I don't have a lot of tech. CEG's having a good day. Yes, sir. This right here, if you want exposure to nuclear utility, the number one nuclear company, this is it right here. Constellation Energy. I do own this one, so I might be biased, but I own them for a reason. I've researched like every nuclear company that exists. There's none more impressive than this one. And the valuation is fair. They're at a 21 times net income. They're on a big downtrend. Even still, even though they're up 3.5% on the day, they're still on a big downtrend. You can get in at a still very fair valuation. But yeah, this company literally owns 30% of all the US's active nuclear reactors. It's the purest play for nuclear energy. And here's my position. I own 15 shares. I'm up 27% on my position. But yeah, I own them for a reason. They're great. They're unregulated utility. So Symbiotic, please. Yeah, here, we'll look at Symbiotic real quick. By the way, we're not really going to be looking at the TikTok stream chat. If you're on TikTok, please go to my YouTube stream. Just type in YouTube Nathan Robert and you'll find it. But anyway, here's Symbiotic right here. This is actually one of my favorite robotics companies. And there's a lot of robotics stocks out there like Rich Tech Robotics, Serve Robotics. Those are both like basically revenue-less startups with no real revenue. Well, here's a robotics company with real revenue, over 1,500 registered patents and trade secrets. And here's like their actual robots. This is specifically a warehouse robotic company. And here's kind of their like selling points: 60 to 80% warehouse labor cost reduction, 15% increased shipping trailer cube utilization. So at store restock labor cost reduction of more than 58%. So that's kind of the thesis behind Symbiotic. And do they have any real customers? Absolutely. Their number one customer is Walmart. And Walmart loves them so much that Walmart decided to buy shares of the company. They're the second largest shareholder. Walmart owns 11.8% of all the shares. But check out this revenue growth. This is what you want to see for a growth stock. Insane revenue growth and good revenue. It's not like a couple mil of revenue a quarter. They did 670 million of revenue this quarter and made net income the past 2 quarters. They're finally making some net income. So that's what's cool about Symbiotic. Check out the future revenue growth as well. Revenue is supposed to hit 771 million in 2 quarters. So yeah, they're on a dip right now as well. They're still a little expensive because they're at a 53 forward PE. So, but that's because they basically just now got net income positive for the first time. So yeah. That's one of my favorite robotics stocks. I also love like Amazon as a warehouse robotics company. Amazon has a great robotics division, but obviously Amazon's not like a pure robotics play when you buy their stock. Someone said BRUN. I've never heard of this one, called Boost Run. They're a $2.2 billion company and they're up 17% on the day. So graphic processing unit. Oh, it says GPU rental services. So they rent out GPUs. So it's one of those cloud companies. I bet you they're renting out their GPUs to cloud companies. So this is basically a smaller CoreWeave, a smaller Nebius, a smaller Iris Energy. So yeah, they literally just rent out GPUs. Same thing that CoreWeave does. All right. Thanks you. BMEA was a risky stock for me anyways. Still very helpful. Hey, yes, sir. Yeah, SoFi. I really like SoFi. That's true. Yeah. All right. So what's up? GBT said MCHI. Is that Mitsubishi or the iShares MSCI China ETF? So if you don't know which Chinese stock to buy individually, this is basically the Chinese S&P 500. I like that its largest holding is Tencent. This is the best Chinese stock ever. Then it's Alibaba, another great Chinese stock. Tencent, if you're a fan of video games, this is the company that owns Riot Games, which is League of Legends, Valorant. They own 49% of Epic Games, which is Fortnite. They own Supercell, which is Clash of Clans, Clash Royale, Heyday, Boom Beach, all that. They own like a 10% stake in Reddit, Snapchat, Spotify, so many great companies. If this was a US listed stock, it'd literally be a Mag 7 company. Pretty ridiculous. All right. Elv, I fumbled Symbiotic so bad I bought in at 20. Hey, you might get the chance to buy back in. Is Amazon still a good buy? I can't imagine it growing much more. I actually do think Amazon isn't the best buy today, but here's where I was buying shares. I mean, I even bought a share like close to where it is today, like at the 220 to $230 level, or even lower would be better. I was even buying shares not that long ago at 198. Amazon is a phenomenal long-term hold. There's little other companies I trust more than Amazon for the long run. It's literally an ETF in one. As you know, they own Whole Foods, the grocery store. They own Twitch, the streaming advertising company. They own AWS, the number one cloud service provider. Obviously, Amazon.com, the number one e-commerce retail. Uh, they own Ring doorbell. I mean, the list goes on, but their most valuable business that brings the most to their bottom line is AWS, Amazon Web Services. This does over 130 billion of annual revenue for them, and it has like 30% net margins. When they ship you a same day package overnight or whatever, that is only like a low single digit margin. It's their AWS that really has the highest margins. But yeah, they're the number one company by total revenue. They're a great subscription play, robotics play, AI play. They're the biggest shareholder, I believe, of Anthropic. They own like 8% of OpenAI now. So yeah, the revenue just hits like a new record every quarter. Number one company by total revenue, over 750 billion a year, and not just revenue, but all actual net income profits on Amazon. So I love this one. I have no complaints. They're spending a lot. Their business model is if another company has a net margin and it's a commodity, we're coming for you. We'll take, if Nvidia sells chips for a 50% net margin, we'll take a 20% net margin. And now Amazon's selling their own TPUs. So, what is this? Threatens 100% tariff on French wine over France digital services tax on Amazon. Hey, oh my goodness. So the administration is threatening tariffs on the French wine over France's digital services tax on Amazon, where they basically, France abolishes its 3% digital tax on major US tech companies, including Amazon, Apple, Meta, and Alphabet. That's funny. France digital tax raised approximately 700 million last year. So, interesting. That doesn't really have anything to do with Amazon, but maybe that'll help out future margins. Interesting there. Anyway, let's see. What's up, My Music? Can you show your portfolio? Well, hey, I got a lot of portfolios. Hey, check out my most recent YouTube video. I do stock portfolio updates all the time, but yeah, I got multiple stock portfolios. And I do a whole stock portfolio update at the beginning and end of every stream where I show every stock and stuff. What up, G? Is Micron a buy? Give me a straight talk. Is Micron a buy right now today? No, in my opinion, not after the stock is at a basically all-time high right now. But if I was a shareholder, is this the time to sell out of Micron and trim them? I don't think so. And here's why it's definitely hard to be bearish on Micron. I'll kind of be quick about this. But if we look at a forward PE, Micron trades at only 11 times next year's net income, which actually starts to seem cheap. I mean, here's the actual net income projections: 22 bill next quarter, 27 bill in net income the quarter after. Net income has never even been close to 27 billion before. So there's still legit like hundreds% more of EPS growth to Micron to come. So that's why you judge them off next year's EPS. And when you do that, they only trade at 11 times next year's net income. So that's not peak bubble valuation, I don't think. This could still stretch up to like a 13, 14, 15 before it fully maxes out. And that sends Micron to like 14, 1500 bucks a share. So, yeah, that forward PE is just low. But who's buying today? That's the thing. What's up, Frederick? Just like on paper, or do you think it would last? Yo, I forgot what I was saying there. What's up, Top Man? I haven't been watching. I'm new. Hey, what's up, man? Thanks for showing up. So what's up, Zizu? Can you do Eaton stock? Yeah, this is a great electrical infrastructure company. Basically, the picks and shovels AI play. These data centers need complex electrical work done for their data centers, and Eaton is a huge beneficiary of that. And they also have this aerospace and defense business that's pretty cool. Yeah, check this out. Aerospace, that's 15% of all their revenue. That business grew 16% year over year. That's actually the highest growth rate on the entire screen. So like their aerospace business growth rate is growing. And just just this quarter that did 1.14 billion. But again, the main growth driver has been this electrical business, doing the complex electrical work. And the net income forecast are good. Net income is supposed to be like close to a billion every single quarter. That's what the analysts are projecting. They had a slight one-time adjustment this quarter. It says they made 800 million. They actually made a little more than that. But yeah, they're supposed to make 1.23 billion in 2 quarters. And yeah, the net income has never been 1.23 billion before. So interesting company here. Free cash flow is great as well. So they print free cash flow, print net income. It's also a great dividend growth stock. So even though this company is close to an all-time high, even if you buy a share right now, you're getting over 1% of your money back just in a qualified dividend every year. So that's what's cool about Eaton. They are on my electrical infrastructure watch list. So they're kind of all my favorite electrical infrastructure companies, like Eaton's on there, Quanta, Amphenol, Simmons, Bel Fuse, Johnson Control, Powell Industries. That's the one I own, POWL. So that's my best performer. All right, so up $2,200 on STX stock. Should I hold? What is STX? Is that Seagate? Okay, Seagate Technology. This is another memory shortage company, I believe. So yeah, this is basically the same thing as Micron, SanDisk. Seagate Technology, execute insider share sales. Okay, some insiders are selling, no big deal. Anyway, what's the forward multiple here? So this one's more expensive than like a Micron. Let me make sure this is a memory company. So yeah, manufacturing and distribution of storage solutions. And the net income forecasts are good. On the left, the net income's 550. On the right, it's going to grow to 1.14 billion. So more than 100% net income slash EPS growth coming to Seagate. Yeah, record free cash flow, record net income. I believe WDC, Western Digital, was a spinoff from this company. Anyway, this one's a little more expensive than a Micron and a SanDisk, got a 45 forward PE. But I would hold, but maybe trim a slight bit. Trim a little bit, because that forward PE does look high. Carnival Cruise Line, what's up, Larry Wilson or Larry? What's up, man? Said CCL, Carnival Cruise Line. Unfortunately, these historically the cruise lines just don't outperform the S&P 500. Technically, Carnival Cruise Line is the same price as they were back in 1998. So that's unfortunate, but they have had a good performance the past, I guess, year. What's cool is that they're finally making consistent net income again. If we look at their net income the past 4 quarters, look at these growth rates year over year. Before today, the net income was really choppy, like they'd make net income and then lose net income the other quarters. But now they've really, evened it out. They're making net income every single quarter. And when we value them off next year's net income, they're trading at a 14.2 forward PE. So this is your travel play, but and here's their occupancy rate, 103%. But inside a recession, or when a recession happens, these just get smoked. Same with the airlines, cruise lines, these just get crushed. And as you can see, they haven't even recovered since the 2020 pandemic price, but they do have a nice yield, a 0.5% yield and a 14 forward PE, but it's just an industry that I don't know if you want to partake in. Actually, one cruise line stock that is super impressive is Royal Caribbean. Remember, Carnival Cruise Line was the same price as they were back in like 2005? Well, Royal Caribbean's at an all-time high, and I think they might even be cheaper. Well, no, roughly the same valuation. You get a 17 forward PE on Royal Caribbean, the same forward PE, a higher dividend, a 1.4% yield, and check out how consistent their net income is. It's actually a lot more trustworthy, I think, than a Carnival Cruise Line. So if you really like this industry, check out Royal Caribbean. I know Disney's expanding their cruise lines now as well since it's getting more profitable. So is it a good time to buy SoFi? It's a good time to nibble on SoFi. Now is not the time. Like if you wanted SoFi as 5% of your portfolio, definitely don't make it 5% of your portfolio today, but maybe make it like 0.5%, or 1%. It's still a pretty small size position for me. I don't recommend having SoFi as like a meaningful size position, but it is a nice small, but it's still a position that you want to maybe still have as a position, as a small size position. Wow. SpaceX is up 14% on the day. Incredible. We want to see the momentum on SpaceX continue because that bodes well for all our other stocks. All right, so okay, what do you think of CoreWeave price target end of the week? So Oliver, I'm not a big fan of CoreWeave. I'd rather own Nvidia, and that's actually what they're in the Nvidia portfolio. So Nvidia's kind of propping up CoreWeave. They're up 7.5% on the day, and I'm sure the stock will probably still do good through the end of the decade. But I personally don't want to own companies that lose so much money. It's like they're just so far away from profitability. It's kind of not even funny. Next quarter, I mean, here's the net income this quarter. They lost 740 million of net income this quarter. Analysts predict they're going to lose 677 million net income next quarter, 600 million the quarter after that. And look at the free cash flow losses. They lost 5 bill, they lost 2 bill, 700 mil, 2 bill, 1 bill. I personally want companies that make net income and make free cash flow that they can return it to the shareholder via dividends, share buybacks, and buy companies. And they can buy companies without having to dilute you or issue debt. So I'm kind of scared of CoreWeave. So the part of the ecosystem I'd rather own is NVIDIA, because all CoreWeave does is buy a bunch of NVIDIA chips and then rent them out to cloud companies. NVIDIA bypasses suppliers to secure copper foil capacity directly. Lock supply 1 year in advance. I wonder, that should bode well for Amphenol stock. Anyway, there's always a bunch of news on NVIDIA. NVIDIA markets Vera Rubin AI data center CPUs to Chinese clients. Target August availability. NVIDIA CEO warns memory chip shortage to persist for years due to AI demand surge. OpenAI negotiates or Apple to use NVIDIA's GPUs via Google Cloud for advanced models. Anyway, we could read. Wait, what did that say at the bottom here? NVIDIA reduces Vera Rubin memory configuration due to RAM supply constraints. Google and NVIDIA consider Intel as backup chip manufacturer amid Taiwan semiconductor supply constraints. Interesting. Anyway, here's why I'm bullish on NVIDIA. If we judge them on a forward PE, next year's net income, NVIDIA trades at only 21 times. So in English, NVIDIA trades at only 21 times next year's net income. That is like so cheap. Like when we compare that to the S&P 500 that trades at like a 25 times, Nvidia is cheaper than the S&P 500, and it has really good growth. Revenue, sales, the lifeblood of the company, that's up 83% year over year, and the net income grew by 210%, which means margin expansion. Look at this. They have like a 60 to 70% net margin every quarter. You get a 0.5% dividend yield on Nvidia. And Morningstar says they're undervalued relative to our fair value estimate. Its entrenched leadership in data center AI infrastructure, propelled by its proprietary CUDA software ecosystem and robust demand for next generation Vera Rubin systems, will drive long-term value growth. So a 21 forward PE, they have a 25% GPU market share, printing net income, fortress balance sheet, printing free cash flow as well. It really is tough to be bearish on Nvidia. Basically, the picks and shovels plays of data centers and AI. All right, what's next here? What dividend stocks do you like? Well, here's my dividend-only portfolio. So you probably won't love this list because these are like dividend growth companies where the yields are kind of low. But yeah, like McDonald's I love, Google, Meta, United Rentals. This is my dividend-only portfolio. But if you want some dividend stocks that actually have a decent yield, these are my like favorite good high-yielding stocks like McDonald's, Procter & Gamble, Lowe's, JP Morgan, Coca-Cola, Johnson & Johnson, Union Pacific. These are all my favorite like decently yielding stocks. All right. I'd really like to buy into Powell. What's your thought if I'm planning to hold long term? Powell is way too expensive to buy, sadly, even close to current valuations because of this 52 forward PE. Honestly, that's what you want to see to buy this at like a 39 or like a 40 forward PE. So you need like a 15% cushion. 10 to 15% cushion on Powell Industries. Even I'm worried about current valuations. So I'm a shareholder of this one. This is the stock I'm up $1,000 on. And would I buy it today? No, but there is a reason they're at an all-time high. They just got their biggest order ever, a mega order they called it, a $400 million from literally one customer, a $400 million data center order. So they have a huge backlogged into 2028. They literally have no debt at all, print net income, has a dividend, buybacks, so all that. But yeah, sadly too expensive. All right, so what's up? Prit said POET. And then we'll look at AAOI stock. I missed that. We'll look at AAOI and PENG. What's up? All right, so Here's Poet Technologies right here, up 17% on the day. So, hey, congrats if you own this company. This one has no revenue yet. I believe this is that photonics company. So, the reason they fell back here is because someone like canceled their order and now they're like reordering. I don't know. The stock is up crazy. The thing that scares me is that if we look at right now's numbers, it's just so little. This quarter, 2026 Q1, they literally did 500,000 of revenue. I mean, that's just so little. 500K of revenue, and they lost 12 million of net income on that. So, you know, oh, but look at the forecast. I mean, I guess they're going to do 2 million of revenue in 2 quarters, but the market cap is, well, I guess it's still tiny, a $2.24 billion company, still a really tiny company, but it's really tiny of a company for a reason. They basically still have no revenue yet. Luckily they have a fortress balance sheet. I'm assuming diluted the shareholder. Yeah, they just diluted the life out of the shareholder to raise cash and pay off all their debt. So it fortified their balance sheet, but you own a lot less of the company. Anyway, I would be super careful with that one. They had a Marvel deal. Oh, that's what it was. So AAOI, this is Applied Optoelectronics stock. I have not heard of this one before, but they are a $15 billion company. Is there any news? Applied to supply Spectrum with quantum leak remote management software. Okay, someone's selling shares. CPO mass production delay. All right, well, they've done great the past year. I mean, look at the stock. I mean, it literally 6 months ago, it was $18. Now it's $192. So what are this future forecasts? So half the revenue comes from data centers. I assume that business, yeah, that business is taken off. It's up 154% year over year. And check out the future forecast. Next quarter, revenue is going to hit 190 million. And the quarter after that, revenue is going to hit 264 million. The revenue has never been close to $264 million before. So I think that's what analysts are probably excited about. A lot of revenue growth, and they're supposed to get net income positive. I didn't even realize that. Yeah. So if we look at the past 5 quarters, or basically ever, they've never made any net income. Here, let's zoom out. Yeah, they've never made net income before, pretty much. And if we go to the forecast, they're actually supposed to make 24 mil of net income. And that's real. They're supposed to make 29 mil of EBIT, earnings before interest taxes. And then after taxes, net income will be 24 mil. Very interesting there. So let's look at PENG stock. And then let me turn on my fan real quick. Okay. So Penguin Solutions, this I believe might be part of the memory shortage sector. So let me verify that. So yeah, integrated memory. So yeah, memory shortage stock. So basically, what's weird is Micron, SanDisk, they're up like 10% on the day. Penguin is only up 1% on the day. Here's why I suspect that. This is one of the more expensive memory stocks. Micron's at an 11 forward PE. SanDisk is at like a 13. This one's at a 29. So this one is one of the more expensive memory companies, but still, I mean, it's had an incredible performance. It went from $18 to 50 or to $64 today, but this one is harder to, that one I'm less bullish on than like a Micron or a SanDisk. But yeah, anyway, if you're in the TikTok stream, I'm actually ending the TikTok stream right now, and I'm only going to be streaming on YouTube. So if you're on TikTok, please, if you want to help a brother out, yeah, I don't know if you can see this, TikTok cooked our stream. I'm ending it right now. Please go to my YouTube channel, just type into YouTube Nathan Robert, and you'll find it on YouTube. Sorry, TikTok screwed me, but yeah, YouTube, just look up on YouTube Nathan Robert. I sell nothing, just on here giving my opinion. All right, so let's see what's next. Oops. Okay, can we get off the screen, TikTok? There we go. Okay. So let's see. Yeah, if you guys got any stocks in the YouTube chat, let me know. I had one or two more backlogged I wanted to get to, but let's see what y'all have. John says, good morning, Nathan. Thanks for doing this. Hey, good morning, man. I hope you were having a great day. They had a Marvel deal. Since it's so expensive, yeah. What would be the next Powell? One stock we were looking at last night, and I did some more additional research on this company, but this is CDNL Cardinal Infrastructure Group. So this is actually yesterday when we looked at this, we thought this was a $1 billion company. It's actually a $3 billion company. So basically, there's the corp. There's basically this is the whole company, but the insiders own this pool of 60% of the company. So out of all this revenue right here, technically shareholders only get 50% of this. So this forward PE of 13 isn't right. They actually trade at like 50 or a 60 forward PE. But let me share with you what's really cool about CDNL, Cardinal Infrastructure stock. They have incredible growth. The revenue year over year grew 104% year over year, and their net income positive. But they have a massive backlog, like an $800 million backlog. They do trenching and the complex work. They just had a massive data center order as well. I want to find their investor presentation. There we go. Investor presentation. So yeah, check this out right here. They do clearing and erosion, earthwork, rock removal, and blasting. And yeah, they have 20% plus adjusted EBITDA margins, a huge backlog. Yeah, an $855 million backlog. They're a wet utility company, really in this North, South Carolina, Georgia area. So it's a really specialized company, and they have some really good guidance as well. Adjusted EBITDA is up like crazy year over year, doing EBITDA. So this is a really cool company. I'm actually watching to buy, looking to buy, but I want a huge dip. They're at an all-time high today, unfortunately, but they're on a massive dip. But yeah, if you're looking for electrical infrastructure companies, here are some other ones to watch. A big competitor would be like Bell Fuse, and this one's only at like a 20 forward PE. This one's close to an all-time high. They're all at all-time highs, unfortunately. PWR as well, Quanta Services, Simmons, Eaton. I got Amphenol on this watch list as well. Johnson Control, this one's a bit of a slower grower, but they're at an all-time high as well. 31 forward PE and a 1.1% dividend yield. Hey, shout out to member Plasma. What's up, man? Good to see you. So, oh yeah, let's do Perimeter Solutions. Why did they drop so much? Oh, okay, this is not Perimeter Solutions. This is Primrose Services. So they fell so much on earnings day. So I actually don't know why they fell so much, but let's go dig into their earnings and see if we can figure out why they fell. I remember I liked this company, but I haven't looked at them in a long time. So they're an energy and utility company. Energy revenue actually declined 13% year over year. So maybe that's part of the reason. So their main segment of business fell 13% year over year. Utility segment did increase 12%. So that's good news. The other half of the business did increase 12%, but maybe the stock fell because their main business, energy, declined that big chunk. So that could be it. Oh yeah, so look at these projections right here. The orange line's kind of what the analysts projected. They expected 41 mil in net income. They only did 17 mil. And the revenue expected was 1.72. They did 1.56. So now it starts to make a lot more sense why they gapped down so big on earnings. It's because they genuinely missed on their top line, their bottom line, and basically every metric. Yeah, looks like look at their net margin. It fell to only a 1.1% net margin. So that might be, yeah, that's probably totally why. And that's real. Yeah, I thought this might have been some accounting trick or something. No, revenue fell 5 and profits really did fall 59. So now it's a question of, do we want to buy a stock that's on a decline like this? We definitely, there's going to be a spotlight on their earnings. We definitely don't want to see their fundamentals continue to deteriorate like that. All right. So, oh, ServiceNow. Yeah, let's do ServiceNow stock. What's up, Zizu? So they gave this 2030 guidance over here. So check this out right here. The second line, ServiceNow raises 2026 AI value guidance and projects 30 billion of revenue by 2030. So in the year 2030, they're going to do 30 billion of revenue. If we go to right now or 2025 full year of revenue, they did 13 billion of revenue for full year 2025. And they're saying by 2030 they're going to do 30 billion. That's a massive increase. What I like about ServiceNow is that their revenue literally hits a new record by the quarter. So not just every year, but by the quarter, the revenue hits a new record. And we don't just want to own a company that's growing their revenue. We want to make sure they're growing their profits and their net income. And they check that box as well. They're a very profitable company, easily making like 400 to 500 million of after-tax net income. But there is one tough part about ServiceNow, and that's the net income valuation. If we go to a PE ratio or forward PE right here, they currently trade at 48 times next year's net income. If we get another huge software sell off, this forward PE of a 48 could fall to like a 40 or a 38, pretty easily and send this down another 15, 20%. So I love how quality this one is, and they deserve to have a high multiple. But in this environment, you wouldn't want to go all in on ServiceNow. Like if you want ServiceNow as 4 to 5% of your portfolio, don't make it 4 to 5% of your portfolio today, but maybe make it like 0.5%. It's like a super small nibble. So point being, you want to be very cautious. Isaiah said United Healthcare at today's prices. Or you also said Enphase Energy. Or should we do Enphase? You know what? Let's do United Healthcare. This one has had a massive little uptrend. The reason they gapped up on this day is because the government finally allowed them to raise prices. So a lot of time, this stock is really in the government's hands. They can't raise prices on their Medicare, Medicaid, health insurance and stuff unless the government literally allows them to. And so that's why, like a lot in the past, this stock has, been so rough because of the heavy government regulatory environment around this company. But if analysts are right about these net income forecasts, UNH actually looks fairly valued. If we look at a 22 forward PE, they trade at, the forward PE is a 22, so they only trade at 22 times next year's net income. That's a fair valuation. We're a customer. We use OptumRx. How's that doing? OptumRx is 155 billion of annual revenue. I know there's also a lot of litigation issues federal watchdog finds United Healthcare among Medicare Advantage insurers with the highest post-hospital care denial rates. United Healthcare's OptumRx reaches proposed FTC settlement over insulin pricing allegations. Yikes. Anyway, so there's a lot of litigation fears, but that's why I would not be allocating new money to this stock after this huge rally on United Healthcare. But does seem like a decent dividend payer. But look at last quarter. They only made last quarter, $218 million. So we definitely don't want to see a repeat of that. So if analysts are right, then they're chilling. Hey, we'll look at ALAB after this. What's up, Ahmed? We'll do Astera Labs after this. Let me do Fox stock right here. So Fox just bought Roku. So why is Fox down 14% on the day? It's because they just bought Roku stock, which I actually think is a good idea for Fox to do. Fox a while back sold 21st Century Fox, basically their entertainment business, to Disney for $20 billion. Now Fox, this stock right here is just their sports and news business left. But check out the forward PE. Fox only trades at 8.7 times forward PE. It's kind of like, cable network television and a television business. I don't know how attractive that is to some people though. But look, they do make good net income every quarter. Like if we average it out, they really do make a couple $100 million of after-tax net income every quarter. Net income projections look really good. They're supposed to make 580 mil, 700 mil the quarter after. So they only trade at 8.7 times forward PE, commodity multiple. But anyway, I actually like that they're buying Roku. They're buying them for $22 billion. Well, Fox is worth $21 billion. So, let's see, ROKU, Roku stock. So there we go. Roku, is worth $21 billion. Fox and Roku are worth the same amount. All right. So, honestly, maybe look into the buying Fox. I don't know. So, they sold off Family Guy and some good shows to Disney. So here's Astera Labs right here. This is your data center communication company. So if you have one data center on AWS and one on Azure Cloud, they install these antennas so they can communicate with each other. So basically this is data center communication equipment, data center equipment right here. So no wonder this stock is at a crazy all-time high right now. They're not just at all-time highs because of momentum. They're at all-time highs because the fundamentals have genuinely improved. And if another company can pull off this growth, they also deserve to pull off this sort of, stock price appreciation. So the revenue this quarter grew 93% year over year to a record. The revenue basically doubled year over year, and they didn't just make a lot of revenue. They got net income positive. They made $80 million in net income for Q1, the highest Q1 ever, and it grew 152% year over year, which actually means margin expansion. The same time last year, the net margin was a 19%. Now the net margin's a 26% for Q1. So margin expansion, so revenue's growing, net income's growing, and a huge cherry on top that takes a lot of risk off the table is the fact that this company is debt-free. Astera Labs has no debt, $1.2 billion of cash, earning interest. So I have no complaints about this stock. Everything checks the box except for the valuation. It's super hard to buy this stock at an all-time high, and when they're trading at 160 forward PE or 160 times next year's net income. So I would not be allocating any new money to the stock right now. Okay, do you have any cheap housing plays or construction long term? Yeah, unfortunately, I did just kind of rally a bit, but this is Cavco. They make factory built houses. They're completely debt free. I'm up 30% on them now, but literally no debt, factory built housing. And they're literally, you can buy a factory built house at a monthly cost the same as renting an apartment. That's kind of their thesis. So this is affordable housing. That's why I like Cavco the most. Um, and more so than a traditional home builder. Like if you look at a Lennar is your traditional home builder. Check this out. This one I don't believe is going to be as resilient. And look at how they've done the past year. Lennar year and a half ago was $180. Now it's $91 today. Massive downtrend. But Cavco, one with no debt, for a commodity, industry, cyclical industry, you want a company with no debt and good fundamentals. Cavco is my favorite one. At a 24 forward PE, they buy back like 3.5% of the shares a year. You know what? I almost want to pull up their investor presentation. I actually did a YouTube video on this stock not that long ago. Can we go to investors? Where's investors? Oh my goodness, I'm trying to find their investor. Well, you know what? We're not going to find it, but anyway, Cavco's a well, you know what? We'll look it up over here. Cavco investor. Here we go. So I just want to pull up this presentation or this quick slide because it really is fascinating. So there's a big shortage right now. So yeah, ownership at monthly cost comparable to apartment rents. So, a lot of people are saying the biggest problem with America housing is the lack of supply. So anyway, this one's really cool because they literally have an unleveraged balance sheet. So they build these factory built homes. So it's a real estate company with no debt. Yeah, zero debt at all, no land risk. They have a backlog as well. See, these are the kind of companies I want to own. So look, their average revenue per house is $103,000. So the average house cost is $103,000 there. They have a backlog of $195 million, 7 weeks of production with no debt. This is a cool one. It's the one I own. So I might be biased, but anyway, they're pretty cool. You also have like a mortgage business where they do insurance on it, and their insurance business has a 60% net margin. I can't believe it. They're doing insurance or whatever on their own factory built houses, and they're only at a 24 forward PE, is apparently extremely profitable, 70% net margin. Anyway, I could go on and on about Cavco. If you want to learn more, I have a bunch of YouTube videos covering them. So, hey, what's up, Gold? Said CTM, please. Yeah, sorry if I'm missing out on some stocks. You're trying not to spam. I'll try and get to all these ones. What are your top 3 safest stocks for long term to buy now or keep an eye on? It would be, safest for super long term. You're gonna call me crazy, but McDonald's. I like trust McDonald's more than like Nvidia for the next 50 years. They're that safe. So at McDonald's, Microsoft, and I don't know what other one would be a safe buy. Anyway, someone said CTM stock. You'd want to be very careful with this one because if you look in the top right, this whole company is worth $67 million. 67 mil. That is just such a tough, like it's so tiny to trust, only $67 million. Like we're trying to invest our money in real companies. This one just, well, let's go see what their financial condition looks like. So they did 14 million in revenue and they lost 350K. So luckily they're barely losing any money. So that's the good news. I mean, if they're only losing $1 million a quarter, that's not too bad. But even when you lose $1 million a quarter, that's still, over 1% of your entire company. And they have a really good balance sheet. So actually out of all the companies worth, 67 million, this one definitely looks like one of the better ones. They have a decently good balance sheet, maybe no net debt. They're barely losing any net income. Revenue grew 22%. What is it that they actually do? So information, so they acquire cybersecurity companies or something like that. I'm trying to click on their website, but there we go. National security challenges. So Castellium joint venture wins position on a $250 million Navy logistics contract. with the record backlog of 273 million. So this company has a $273 million backlog. They're a cyber electronic warfare software company focused on the federal government. Revenue up 123. Total backlog reached 273 million. Qualified pipeline totaled 938 million, reflecting. Okay, well, anyway, I'm not too sure what this company does, but it definitely is interesting. How about GPUS? Is that, oh, like GPUs? Oh, that's funny. So this is actually a stock. Dang, so look at this company right here. They're at an all-time low. Because of all the reverse splits they did, this one share price used to be $2 million per one share. So that's what happens when you do a bunch of reverse splits. Your stock just spirals to zero. Anyway, this whole company is worth $109 million. So an extremely small market cap. So here's the thing. Just imagine this. This is how I like to judge a company. You could buy the whole company for $109 million. Let's say you do it. You buy the company for $109 million. Well, here's what you bought. You bought a company that just lost $30 million. There goes 30% of your entire investment. The quarter before, another 30 million, 15 mil. So not a stock I would trust, really. It could be a fun momentum, short-term swing trade, day trade, but not one you'd really want to trust meaningful money in for the long run. You know what I mean? Those fundamentals you just cannot trust. Hey, what's up, Hunter? Red said, want to see a good balance sheet? Look at CALIX. CALX. Okay, we found it. Okay, cool. I've actually never heard of this stock before, so let's check it out. So this is a $2.5 billion company. They're on a downtrend right now. Let's just go straight to their balance sheet. Yeah, they do have a good balance sheet. Looks like they have $240 million of cash and no debt, no long-term or current debt. So they have 250 mil of cash and no debt. And let's see if what their revenue growth is. So revenue grew 27% year over year, and they made 11 million in net income on that. So looks like they kind of used to make some consistent profits back in 2021. Then it kind of got choppy, but now it's back. Looks like they are finally making consistent profits again. Let's see. Yeah, analysts project 10 mil next quarter, 14 million the quarter after. Revenue is supposed to go to 300 mil. So maybe the growth is finally coming back to this company. So they're a software company. Okay. Communication software for fiber and copper-based network architecture. Huh. You'd think that'd be used in a bunch of data centers right now because there's a big copper cable shortage. Huh. Gateway Appliances receive FCC approval. Interesting company there. What was the valuation on that company? We forgot to check. They are at a 43 forward PE, so that's the tough thing. Even though they're on this massive dip right now, they're only trading at 43 times they're trading at 43 times next year's net income. It seems expensive, but also they just got net income positive for the first time ever. Someone said, Tom said, what stocks are you buying? I'm actually not buying anything right now, and I just rose some cash. So right now in the top left, I have cash on hand of $870 in here. I have another $500 elsewhere ready to invest. I've looked, there's really no good deals right now. I've done my nibble on Netflix, so that's where I spent my first load of cash, but I'm being disciplined. The only thing I'd really buy more of is Netflix right now, but I'm not buying any more Netflix until and if it falls 5 to 10% more. That's the only scenario where I'll buy more Netflix. I'm trying to be disciplined in this stepping stone game where I'll only buy more once and if they fall 5 to 10% more. And if they don't ever fall 5 to 10% more, then GG, I tried. But yeah. All right, so AMCR, large manufacturing company. So this is Amcor, okay. Oh, and then I can see Rolls-Royce stock, okay. So here's Amcor right here. They're a $19.3 billion company. They're on a downtrend, though. They're kind of at their 2020 pandemic prices. We'll answer that in a second here. So they do global flexible packaging solutions, and that business grew 35% year over year. Global rigid packaging solutions, whoa, that grew 187% year over year. So when we combine the two businesses, revenue combined grew 77% to a record revenue. Record revenue this quarter, but the stock is on a massive downtrend despite that. So maybe that was fueled by basically an acquisition. Maybe that's not organic revenue growth. Yeah, it looks like that was fueled by an acquisition, that growth right there, but that's okay. They're still making every quarter roughly 200 to 300 million of after-tax net income, excluding the one-time acquisition adjustment they had right here. So when we do a forward PE, yeah, they're at like a 13. That's what like UPS trades at, like a 13 forward PE. So maybe this is like international UPS. North America's 50% of the revenue, then it's Europe, Latin America. They have a huge dividend just like UPS. UPS is a 6.2% yield, and this one has a 6.2% yield as well. So they do packaging in containers. They're headquartered in Switzerland. So this isn't a US company. Man, wait, hold on. I have seen their logo before on the side of a warehouse, I feel like. Anyway, there's Amcor for you. Hopefully that was kind of helpful. Love your lives. Hey, I appreciate that. Ooh, watch out for that person in chat there. Hold on. All right. Yeah, you have like 50 stocks. You need to sell some stuff. Yeah, exactly. I know. That's my one thing. I got way too many stocks, or especially in my Webull portfolio. I have 19 stocks in this portfolio. So yeah. So someone said, is AMD a buy? So I actually say no. Today, I actually just sold another share of AMD literally today. There's the little sell order right there. So yeah, and that's how I have all this cash right now. I sold that one share of AMD, and that's how I have, $870 of cash in here. So yeah. All right, so Luke said Rolls-Royce stock. This is a cool ADR. A lot of people, when they think of Rolls-Royce, they think of the cars, the fancy cars. But Rolls-Royce is actually an aerospace and defense company. A lot of, jets, aerospace jets, or defense jets use their actual like jet engines. So yeah, civil aerospace, that's 48% of the revenue. 23% of the revenue is power systems, and then defense is another 22% of the revenue. They're very geographically diversified across different countries buying their products. But yeah, this is a UK company, so they report their earnings in H1, which is first half and full year. So yeah, full year 2025, they did 7.8 billion in net income. I mean, they're the most profitable they've ever been pretty much if we zoom out. So yeah, that's why I like Rolls-Royce. They are expensive though, trading at 36 times next year's net income. But like all aerospace and defense companies are trading really expensive right now because it's the sector. If war fears start to escalate and stuff, Rolls-Royce will benefit from that. My aerospace company is Moog, MOG.A stock, and they're also expensive at a 37 forward PE. So yeah, it's like the high quality aerospace and defense stocks are expensive right now. Moog is a fascinating company. All right, so next up here. Sorry, I missed your analysis on AMCR. Could you tell me the last bit? I'm at work. Yo, Osik, I am so sorry, man. By the way, if you want to actually check my analysis, please go to my YouTube channel. If you just type into YouTube Nathan Robert, you can actually like rewind the stream like 5 minutes and watch it. I did like a deep dive on them. But anyway, they're basically like an international UPS. They have a 6% dividend yield. I'd be careful with AMCR. They're like international UPS with a 6.2% dividend. You kind of buy it to maximize your income. So here's PayPal. So yeah, what's up, man? Here's PayPal. And I also see QNITY stock. We'll check that one out. So, sorry. Here's PayPal stock. This one is kind of on they're sadly PayPal is the same price as they are back in 2017. So if you bought PayPal in 2017, it's the same price that it is today. But it's not just PayPal's fault. PayPal owns Venmo. If we go to Cash App stock, Block, which is Cash App, is also the exact same prices they were back in 2018. So I think this industry is just kind of being out innovated right now. All they do is a commodity. What is PayPal? You send money from one person to another, or you pay for something with PayPal. That fee they collect should go lower and lower over time because it's a commodity. And that's why I think PayPal's kind of struggling. They're kind of being out innovated right now. But that's why they're so cheap. They're trading at literally a commodity multiple, an 8.3 forward PE. So they traded 8.3 times net income. I mean, just ridiculously cheap. But I do know that the revenue kind of has been like low single digits. Like revenue grew 7, it grew 3, 7, 5, 1, 4. So it's kind of like grows mid to low single digits. And the net income declined 13% year over year. But still, they easily make over 1 billion of after-tax net income a quarter. So they really do trade at only 8 times or 8.3 times net income. So, and what they're doing is share buybacks. So as we see, the net income fell by 13.5. the net income per share only fell by 6%. How did the net income per share not fall as much? Well, it's because of the per share part of the ratio. They bought back here. I'll show you the exact numbers. It's in the cash flow statement. So PayPal legit spends $1.5 billion almost every quarter solely buying back their own shares. And that's how they're kind of returning money to the shareholder right now. And they pay a dividend. So if you buy them, you get a 2.5%, or I don't know what that yield was. Get a nice yield on them too. So, we see QNITY. Yeah, then we can get Qnity Electronics. I'm going to try and get to, we just looked at this Astera Labs, so we can get to Ouster stock. Can you see for Intel? Can Intel keep going up? We'll look at Intel too. I am bearish on Intel's current valuation, the same way I'm bearish on AMD's valuation currently. It's just too expensive. But that's why I just trimmed a little bit of AMD. But I'm definitely not fully selling out, and I would not allocate new money to either Intel or AMD. But we'll look at Intel after this because they have very justified reasons to be at all-time highs. So here's Qnity Electronics. They're at a close to an all-time high today. So they, of course, do semiconductor technologies and interconnect solutions, and I bet data centers are eating this stuff up right now. All right, so are they profitable yet? Let's see. Yeah, they're already profitable, easily making like 1 to 200 million of after-tax net income every quarter. Revenue's up 17%. That's the highest growth rate on the screen. So when we do a valuation, though, they trade at 42 times next year's net income, which is expensive. But again, they just IPO'd. Anyway, they pay a dividend. You get a small dividend. A 0.1% yield, but the payout ratio is only at 1.8%. Anyway, looks like they do interconnect solutions and semiconductor technology. Pretty interesting. And all these other like interconnect stocks like Amphenol right here, APH, which does the copper cables for Google's TPUs and NVIDIA's NVLink Spine, is close to an all-time high today as well. Corning is. Can you look at OWL? It has a 9% dividend. Yeah, this is Blue Owl Capital. This is a BDC. So what that means is they are a business development company, and these are unique because by law, they have to pay out 90% of their taxable income in the form of a dividend. So that's why when we look at their dividend yield, it says 9%. And it's actually not abnormal for them to have a 9% yield because of how they're taxed as a BDC. And technically, what you receive as dividends aren't dividends, they're distributions, and they're taxed as short-term capital gains. So whenever you receive that 9% dividend, you pay a little bit higher tax than a normal dividend. But anyway, what this does, they do first lien and second lien loans. Looks like they trade at 7 times next year's EPS. But notice they miss on EPS / net income every quarter. The orange line is what like the analysts predict. The blue line is what they actually report, and they do kind of miss every quarter, which is a little weird. But you don't really look at net income to do a dividend payout ratio on these BDCs. Anyway, you buy that to maximize your dividend income. I know with the private equity, private credit crisis that happened a few months ago, Blue Owl has been on a massive downtrend. Blue Owl's the one funding Meta's Prometheus data center bond issuance. Do you think CNQ will get any cheaper? So CNQ stock looks almost like what oil is doing right now. That's because they're really tied to oil prices. If we look at oil on the day, oil is down 4% right there. And Canadian Natural Resources is down 3.3% on the day. So the charts do look pretty similar. So yeah, exploration and production, oil sands, pretty much just an oil and gas company that's headquartered in Canada. And they traded an oil and gas type valuation at only 10 times forward PE. They make a couple bill of net income a quarter. We've converted it from CAD to USD. So yeah, actually, if you're bullish on oil, this would be a stock to buy. And it should be a nice dividend payer as well. Yeah, 3.9% dividend yield. Not too shabby. All right, so Ouster. So here's the thing with Ouster. They are a LiDAR company. They have the world's first colored LiDAR. And today, Ouster expands their partnership to support Rev 8 sensor production. They hit like the certain milestone, and now they're producing over 100,000 more units of LiDAR. And what uses LiDAR? robotaxis and autonomous vehicles on the road. So not just robotaxis, but also drone defense systems used to detect drones. LiDAR is used for that as well. So anyway, there's just a lot of tailwinds headed for the LiDAR industry, and this is just my favorite LiDAR play. Would I buy the stock today after it literally has gone up 160% in a month and a half? No. Um, because I do own 4 shares. That's what I say that because I bought this stock a month and a half ago and they're up 160%. I can't believe it. Yeah, Ouster expanded its manufacturing partnership to scale Rev 8 LiDAR production to over 100,000 units annually, driving the stock up 16%. So there we go. Pretty cool LiDAR company. It's one you'd want to have as a small position because Ouster still is a money loser. They don't make any net income yet, but they're still a pretty interesting company. Hey, what's up, Green? Green Owl. Hey, instead of Blue Owl, we got Green Owl. At some point, a crypto should make PayPal and Cash App obsolete. Yeah, that's the tough thing about PayPal. Hey, what's up, John? He said, look at Fidelity stock. Yeah, let's check it out. FIS, and then we can look at KLAC and Exxon. We'll look at a few more here. So Fidelity International, this is Fidelity is like a brokerage. I wonder if Fidelity's, or let's see what they do. Are they a bank or yeah, banking solutions, capital market solutions? Huh. You know, that's weird is JP Morgan's at an all-time high, Citigroup, yeah, Goldman Sachs, Morgan Stanley, all these stocks are at an all-time high when Fidelity is like literally at an all-time low, lower than they were in 2001. I wonder, is this the like real official Fidelity website? Like if you click on their website right here, okay, they're trying to get my cookies, so hit the like button for me. Here's their website right here. Um, hmm. Maybe it's a change for the better. 35% reduction in energy use. Okay, well that doesn't have anything to do with them. Anyway, FIS and Anthropic signal new era of infrastructure and banking. Anyway, some sort of banking company. What's the valuation? So here's the super weird part. Even though this stock is at an all-time low, they trade at an 11.5 forward PE. If we look at JP Morgan, that's at basically an all-time high, even close to an all-time high, JP Morgan trades at a near similar valuation at a 14 forward PE. So Fidelity, even at an all-time low, is just like barely cheaper than JP Morgan at all-time highs. So I wonder if they're having their own internal issues. Let's see if Morningstar covers Fidelity actually. They don't. Or wait, do they? No, they don't. Morningstar Research. Okay, here's what the bulls are saying. The bank technology business is very stable. Core business processing, sticky relationships. But compared to peers, FIS's customer base skews more heavily to large banks, which have greater bargaining leverage. FIS's bank technology operations are tied to a mature industry, which limits its growth. The sale of WorldPay business has been unnecessarily complicated. Anyway, I don't know about that one. I'd just be careful. So, wait, what did I want to look at next? Oh, yeah, KLAC. What is this stock right here? So, this is KLA Corp. They're at an all time high today. Yo. So, if you've ever bought this stock, congratulations, because you're definitely up on your money. And hey, what's up, MC? Yeah, we'll look at like the, hey, what's up, Ludo? Yeah, well, those are great stocks. Yeah, all those are phenomenal. I haven't looked at maybe one or two of those, but hey, what's up, SMH? It's Anthony. Yeah, we'll look at the SpaceX IPO too. So here's KLA Corp at an all-time high right now. Is there any news? Multiple analysts raise price targets, citing multi-year semiconductor equipment upcycle and AI-driven growth. KLA completes 10-for-1 stock split. Cool. Anyway, congrats if you own this one. They're at an all-time high. Seems like some AI beneficiary. Although the company benefits from medium-term AI growth cycle, the market is priced in supernormal growth that extends beyond the next 3 years, failing to fully account for inherent growth could warrant caution. Anyway, yeah, where's the valuation? Yeah, so at a 54 forward PE at an all-time high, I would not be allocating any new money to this stock. You know, the risk reward doesn't exactly look great at an all-time high and at a 55 times next year's net income, but I can see why they're at an all-time high and why they've done so good. It's because of their semiconductor demand, you know, semiconductor process control, printed circuit boards, specialty semiconductor process. So when we combine all their businesses together, revenue grew 11.5% year over year to 3.42 billion. So look at the revenue this quarter. It was 3.42 billion, a record. 3.42 bill. check out the projections. Revenue is supposed to hit in 2 quarters 3.9 billion. So there is still massive growth to their top line and bottom line. Yeah, net income is supposed to hit 1.44 billion. Has the net income ever been close to that before? Never. So net income's going to 1.44 bill. Anyway, congrats if you own KLAC. They are quality. So what? Oh yeah, ExxonMobil. This is my favorite like oil stock. I think this is like the growthiest oil stock. Like I'd rather buy ExxonMobil than a Chevron. But yeah, this stock is just tied to the oil commodity price. It's basically handcuffed to what actual oil prices are doing. Because here's oil right here. USO, United States Oil, is down 4.2%. So Exxon's down 3.9, or basically 4% on the day as well. But yeah, if we get, this is a nice hedge. If war fears start to escalate, Strait of Hormuz fears, shipping sea routes getting closed again, that would be good for ExxonMobil. And it's a nice hedge to kind of diversify away from tech if you don't have any exposure to maybe like a safe haven asset. And you get a nice yield in the meantime while you're just sitting there chilling. You get basically 3% of your money back just in a qualified dividend every year. They traded a 10.6 forward PE, 10 times next year's net income. That's normal for commodity stocks. But yeah. What's up? No Name said ASML. Yeah, ASML, this is that lithography company. It's impossible to replicate their technology. China tried to smuggle, this is a European company. China tried to smuggle their like lithography machine and reverse engineer it. First off, they tried to do it and they couldn't do it, but then the US like military FBI came in and like recovered the stolen machine. But to ship one of their lithography machines, it literally takes like 2 Boeing like 747 planes to ship just one of their lithography company or devices. They have 3 main customers, or basically they only have 3 customers. Those customers are Samsung, Intel, and Taiwan Semiconductor. And if you don't know, there's a massive chip shortage in lithography machines. These are the chip making devices. There's a huge chip shortage. Taiwan Semi is saying we're buying more ASML, and Intel it was producing more chips and CPUs and stuff. Intel's buying more chips from them. And now Samsung, with this memory shortage, Samsung's buying more from ASML. So they make these incredibly complicated machines, and they're expensive though. They're at a 48 forward PE, or they trade at 48 times next year's net income. It's a little bit too expensive for a great risk to reward. To buy the stock right now is definitely tough, but they just beat expectations. The orange line is what analysts predict every quarter, and this is in USD. They are a European company, but we've converted the currency to US dollars. They expected 2.93, they did 3.18, and next quarter they expect 3 billion and then 3.7 billion in net income the quarter after. The net income has never been close to 3.7 billion before. That's what I like to look for in companies. Still, with there's always a reason usually why a stock is at an all-time high. This has the DNA of a stock that would be at an all-time high. Great future net income forecast, margin expansion, net margins are up, revenue's up, net income's up, they pay a dividend. It's kind of like a mystery dividend as well, because they change it every quarter. You get $3.16 this quarter, the last quarter is $1.90, $90 before that. Anyway, pretty cool. Hey, what's up, OLP Papa? Yeah, hey, thanks for those gifts there. Happy summer. Yeah, thanks for those summer subs. Yes, sir. I am out of college for the summer. I am still taking a little small one class to get some extra credits. But yeah, basically, I got no college until August. So I'm going to be streaming more. Yeah, if you guys want to hit the follow button, I greatly appreciate that. Subscribe button. I try and stream every day or every other day. I sell nothing at all. I have no course, book, WhatsApp. I'm just on here giving my opinion. So what's the difference between net income and revenue? So a company brings in revenue, of course, but then there's taxes to pay. And if they have debt, there's interest to pay. And if they're stock-based comp, you got to include that in net income. So here's the total revenue of this company, 7.6 billion, but not all of that is actual net income. This is what you really want to look at as a shareholder, the after tax, after stock-based comp, after interest number. Basically, net income is the best metric to look at, because that's what goes to EPS, which is net income per share. That's the main metric you look at as a shareholder, is how much net income you get per share, because each share is like a literal living, breathing piece of the company that literally, if you buy one share of this company for $158, it literally gives you back 72 cents instantly, 93 cents instantly, 97 cents instantly. But instead of giving it to you in a dividend, you're trusting the company to reinvest it for you in the business. But if they were to, like, literally, if they mathematically, you basically get, if you put $150 in, 70 cents back in 3 months, 93 cents, 97 cents, basically whatever they make. Anyway, hopefully that was kind of helpful. So, what's the free cash flow? Or I forgot to look what company, but or what maybe you're saying what is the free cash flow? What is that? So yeah, that's basically the revenue. Or what's a great stock we should look at? CoreWeave would wow. No, Amazon. You know what? So this is a huge issue right now is a free cash flow issue. So a company can make a bunch of net income, but then there's something called free cash flow that affects the cash on the balance sheet, and that's tied to CapEx. So the free cash flow is the operating cash flow after CapEx. So this is the cash from operating activities, 26 billion. Then you have to add in CapEx, which is, spending on chips, spending on data centers. And here's the actual free cash flow metric on Amazon. Amazon went negative 18 billion of free cash flow. Amazon basically is making no free cash flow right now. So it's because they're spending so much on CapEx. So they're not retaining any other money. So basically, no money is being added to their balance sheet every quarter, which is okay for me. I want them to spend all that they're making. But for the most part, you want companies that print free cash flow. Oracle is another great example of one that, here's Oracle's net income. Oracle prints net income every quarter, a couple billion in net income every quarter. But when we look at the free cash flow is extremely negative because they are spending legit billions, tens of billions of dollars a quarter on chips to the point where they're spending more than they're making. That's where the free cash flow gets negative when they spend more than they make. Okay, can you check Nebius? Good growth in a backlog. So that's an NVIDIA holding. You know what? What's up, MC? You know me, I'm not too big of a fan of Nebius because of the industry. So what does Nebius do? All Nebius does is rent out GPUs. So they own a bunch of graphics cards and then they rent out those GPUs to people. But here's the tough thing. Nebius is supposed to lose a lot of net income. Ignore this quarter. It says they made 620 million net income. That's not true. They actually lost 128 million. This was some accounting FUD, accounting trick that they did to make it look net income positive. It wasn't real. So the core business actually lost 128 mil this quarter. So first off, here's the profits. They lose a couple hundred million net income a quarter, and here's the free cash flow. They lose a couple hundred million to $1 billion of free cash flow a quarter. I'd be okay with this free cash flow burn if they were at least net income positive, but they're not. And here's what analysts project. Next quarter, Nebius is supposed to lose 223 million, and then the quarter after that, they're supposed to lose 305 million of net income. That's the one scary part. Yeah, even EBIT, earnings before interest taxes, they're supposed to lose 160, 170. So I personally don't like companies that lose net income and lose free cash flow, because I want companies that make net income and free cash flow, because that's how they return money to you as a shareholder via dividends, share buybacks, and do M&A. But this stock still does insanely well because they're getting new deals. Wow, Nebius to join the NASDAQ 100. I actually don't like that. But that will prop up Nebius's stock. I wonder if that's why they're up 12% on the day. Anyway, this one will probably still do good to the end of the decade. As long as Nvidia's doing good, this one will probably do good. But I don't trust this one because of the financials. They lose a 1 to 200 mil a quarter. That's what they're projected to lose, or even 300 mil in 2 quarters. And the free cash flow is really negative. But they do have good revenue growth. I mean, the revenue is supposed to grow to 930 mil, but it's just again, they rent out graphics cards. That's the same thing Iris Synergy does. That's the same thing APLD does. That's the same thing CoreWeave does. Yeah. Yeah, the revenue growth is the only thing that can, maybe justify it. But even though the revenue growth is there, so check this out. As we know, the revenue is supposed to grow to 900 mil. So the revenue is going to 4 or 5x. Revenue is going to grow like crazy. But the losses are supposed to worsen by 3x. They're going from losing 106 mil to losing 305 mil. That's the only scary part about Nebius. I bought ASML last March, topped off at 40 shares, not adding more. Yeah, I wouldn't add more at these prices, but yeah, I would just hold on to your shares. Hey, what's up, Vagabond? He says, what's up? Hope everyone's doing well. Yes, sir. I bet everyone is doing well because the market's having a fantastic day. QQQ is up 3%. Oil's down 4%. And my portfolio, or this portfolio on the day, is up 2.7%. Not too shabby. And this account is up even more, 3.18%. And then the Webull portfolio is up 3.71%. This one's up 32 grand all time, or 32% all time. I wish All right. So, let's see what's next here. Hey, Nathan, what's your take on Comfort Systems and why you're planning on holding it? What's your projection for the business in the next few quarters? So, yeah, basically, I am. So, you can always sell a stock for a loss, but technically, upside can be infinite on a stock. And, I am going for something crazy. I'm going for a multi bagger on Comfort Systems. Even like this is a stock you do not buy today. It's definitely not worth buying today. But as a shareholder, I'm just not selling my position. I'm up 19 grand or 442%. This has the DNA of a stock of a multi bagger. Check out the net income projections every quarter. Orange lines what the analysts expect. The blue lines what they actually report. This is the best stock I've ever analyzed, I think, in my entire life. And that's why I bought them as my biggest position ever. I put like 5 grand into the stock and it's appreciated so much. So they beat on revenue every quarter. They beat on net income every quarter. They have literally no debt, completely debt free, like a $15 billion backlog. 10% of their revenue comes from AWS. The revenue grew 56%. So the revenue's up 56. The after-tax net income is up by 118. That's margin expansion. Net margin went from 9% to 13%. Gross margins went from 22 to 26%. And check out the balance sheet right here. They have 1 billion of cash now, the highest cash they've ever had, just chilling on 1 billion of cash, a 13, $15 billion backlog. And basically just incredible EPS, free cash flow. There's nothing that disappoints me here. Only thing that might be a little concerning is the 44 forward PE, but this is a 44 forward PE, assuming they just hit these orange numbers. Every quarter they beat by a huge chunk, so they could really be trading at like a 41 forward PE, and when you even do an X cash multiple, it could be like a 38 forward PE. So anyway, that's why I'm not trimming or selling my Comfort Systems, even though I'm up 19 grand or 440% on them. But yeah, that's led to all of our gains. We bought the stock during the tariff dip way back here. And here's a little screenshot of my portfolio from exactly 1 year and 1 month ago. Check out at the top there, Comfort Systems. I had 11 shares. I used to be down 16% on them. Powell Industries, I used to be only up 110. I was down on Amazon, barely up on Amphenol stock. And in just a year and a couple months, it's basically changed my life. Literally a year and 3 months ago, I was down 16% on this stock. And in 1 year and 3 months, it's gained 400%. And that's why this portfolio has done so well. Also because I haven't sold anything, but basically all of our gains have came from this past year. 1 year ago exactly, we were doing just as bad as the market, but now we're up 167% in 1 year, or 32 grand, which most of those gains came from Comfort Systems. Anyway, that's your HVAC company and MEP company doing the complex mechanical and electrical work. Yeah, if we go to their electrical segment right here, which is 28% of their business, it grew 87%. So there's a lot of HVAC companies out there, heating, ventilation, air conditioning companies. But some of these, like Watsco, most of them are residential exposed because Comfort Systems, this is not the company that comes to your house and fixes your HVAC system. Comfort Systems is the company where they do this for C&I customers, commercial and industrial customers, and specifically those have been data centers. So that's why Comfort Systems has outperformed companies like Watsco and some of these other ones, like Carrier. Anyway, that's my largest holding. I love them. Hey, Sharkwater. Yeah, Ouster's up 16% today. They hit new revenue, or they hit new targets, and now they're upping their production on new demand. It's official. United States is broke. Oh no, where did that come from? The United States makes roughly $70 billion a day in GDP. But a lot of that GDP goes straight to like government programs like Social Security, Medicare, Medicaid, and then we're so we make 70 billion a day in GDP, and we spend like 78 billion a day. So we add to the debt every year. We have a huge deficit, and we continue to add to the debt problem every year. It just never gets fixed. We just keep kicking the can down the road. But you know what fixes debt? Inflation. So inflation makes the debt easier to pay off. And when inflation goes up, the government just collects more taxes. And anyway, inflation's one way to solve the debt problem. But anyway, and how do you beat inflation? Well, if inflation happens, what's the best historic hedge for inflation? That would be stocks. Okay, anyway, Eaton right here. This is an electrical infrastructure company with a nice dividend. You buy a share or you buy the stock right now, even though it's gone up a bunch, you're still getting over 1% of your money back every year in a qualified dividend. So you get a nice 1% dividend yield. They are expensive though at a 32 forward PE, but part of the reason they're expensive is because they're also an aerospace and defense business. If you look at any aerospace and defense company right now, they're really expensive and they're doing really good. And their aerospace business, like the growth rate is growing. It's up 16% year over year. So the aerospace business is doing good. Their electrical Americas, check out the past 2 quarters. It grew like 20% the past 2 quarters, the highest growth rate on the screen as well. So that's really what's leading them to boom. This company should just benefit from the electrical super cycle that data centers are doing. And they had a slight one-time adjustment this quarter, but they're easily making over $1 billion of net income every quarter. And that's what that's what the analysts are projecting in net income the next few quarters. They're projecting $1 billion next quarter and $1.23 billion a quarter after. So a nice little dividend growth company, but you probably want to be cautious at a 32 forward PE. Morningstar says the company benefits from strong structural demand in data centers and electrical grids. Its overheated valuation and sluggish vehicle segment demand require caution. Oh, I probably should have mentioned that too. So 10% of the revenue is this mobility like car business. And I guess yeah, look at full year 2024 to 2025. It actually declined by 8%. So I guess the mobility segment, I think they're even planning on spinning that business off. I heard about that. Oh, well, look, it's freaking right here. Ian to separate Mobility Group and merge with Dana and 5.1 billion reverse trust transaction. Anyway, they're spinning off that mobility low margin business and focusing on their high margin aerospace and electrical infrastructure business. So let's check out Ferg stock. And again, sorry if I'm behind here. I'm seeing a lot of stocks here, and I'm just trying to get to all of them on both chats. I see Grab. Yeah, Sinner. We'll look at Grab next and TTWO. Hey, thanks, Sora. He says, loving the content. Yeah, we'll look at TTWO. That's GTA 5, GTA 6 stock. Pretty cool. All right. So who are you talking to? Yeah, we're reading both chats right here. What was the ticker again? I think that was ETN, ETN. By the way, I'm streaming on YouTube. You can like rewind it over there. I'm kind of reading the TikTok chat first. I'm mad I missed Talent Energy, TLN. Yeah, Talent Energy is another nuclear company. I think they own like 3 or 4 nuclear reactors, and Amazon signed a deal with them. So here's Ferguson right here. I've not heard of this one, I don't believe, but what industry are they in? Industrial distribution business. So they do plumbing, heating, ventilation, air conditioning, piping. Well, check this out. That's an industry I'm a big fan of. Sounds like Comfort Systems. And look at the forward multiple. They're only at a 21 forward PE, so they only trade at 21 times next year's net income. That seems very fair in my opinion, but I think the reason they're maybe at such a low multiple is because of a net income decline. So if we go to the lifeblood of the company, the sales, the revenue, it actually declined 3.8% year over year. So revenue is actually in negative territory, and the revenue was down 3. The net income is down by 11.9, which actually means margins are going down. Net margin fell by 8% year over year. So now it starts to make sense why this stock actually gapped down. And it's kind of been flat for a year. So we kind of want to see the growth come back. But that being said, they're still making a couple $100 million in net income every quarter, and the forward multiple is a 21. So maybe we're close to the bottom at a 21 forward PE. All eyes are really just going to be on them bringing their growth back because, yeah, we don't like seeing negative revenue and negative margin, negative growth. So interesting, though. All right. Check out Hubble. Haven't looked in much into them. Yeah, Hubble. This is on my electrical. This is a big competitor to Powell Industries. By the way, if you're on TikTok, I am about to end my TikTok stream. I don't know if y'all can see this, but my stream's restricted for unoriginal or reproduced content. This is in line with the TikTok live under our community guidance. I guess I can appeal it, but we're cooked. So the TikTok stream's cooked. Basically, if you are joining me and just want to support me, please go watch from YouTube. Just type into YouTube Nathan Robert. You'll find the stream. That's the only way to support me. And if I sell nothing, I promise. I have no course book. I don't coach, literally nothing. Only thing I have is a YouTube. So if you have a stock you definitely want me to analyze, I promise I'll analyze it if you go over to the YouTube chat and say it. So here's Hubble right here. This is an electrical infrastructure company, just like Powell Industries, doing the complex electrical work for data centers. So let's see how they're doing right now. So utility solutions, which is helping out the grid, and electrical solutions. Let's see how the electrical solutions is growing. And that's up 11.75% year over year. You know, a business that used to grow low single digits or sometimes even grow negative is now growing a nice double digits. And the other half of the business, utility, is also up a nice 10% year over year. So both businesses are growing double digits. The net income forecast is good. supposed to hit 264 million. Yeah, wow, look at that. If you zoom out over time, net income continues to climb. Hey, Sania, thanks for going to the YouTube stream. I appreciate that. Thanks so much. So yeah, they're easily making a couple hundred million of net income every quarter. Net margin is a nice net margin expansion, actually. They have like 15, 12% net margins now. Nice little free cash flow. So they only trade at a 26 forward PE. So even though this stock, if we zoom out, yeah, they're up crazy from 2019, but in my opinion, this is not peak bubble valuation. At only a 27 forward PE, only 27 times next year's net income, this still has room to stretch up higher, go into like a 33 or 35 before it maxes out and send this up another 30% to a new all-time high. So that's one you could put on your watch list if you're a fan of electrical infrastructure. Yeah, same with Eaton. We just looked at Eaton. Here's my whole watch list for electrical infrastructure. I have Hubbell on that list. Eaton's there, Hubbell, PWR, Powell Industries, Simmons, Johnson Controls, a decent, another kind of like Eaton, where even if you buy the shares today, you still get over 1.08% of your money back in a dividend every year. So I also own Powell Industries. So that's what I'm a big fan of. You don't just have to own NVIDIA, own the whole AI ecosystem, own the companies that do the MEP work, the complex electrical work, mechanical work, plumbing work, the companies doing the HVAC work, heating, ventilation, air conditioning, the ones supplying the ecosystem with the copper cables. They supply the copper cables and fiber optics for Google and NVIDIA. You can also own the companies supplying data centers with clean nuclear energy. And CEG, this is the purest play for nuclear energy. They own over 30% of all the US's nuclear reactors. And you can own the companies that are constructing the data centers. Think of United Rentals and Caterpillar with their heavy machinery. So that's the sectors that I've been looking into. You have 5K. What are you buying? Amazon? Definitely Amazon. Amazon, you maybe want to wait for a slightly lower position, but if you're looking for stocks to buy today, like if you're just like a long-term buy and hold investor, looking for great stocks to hold for the long run, Microsoft is one of the best ones right now, not financial advice. It's another Mag 7 safe company you've heard of before. You want to own companies you've heard of before and know of. Don't just buy some micro cap that has a cool website. Microsoft right here has only trading at 23 times net income, is also on a massive downtrend. I also just bought 3 shares of this company. Microsoft's a great one that you can just sleep well at night with. What else is kind of a good deal? Unfortunately, I wish I could give you more good deals right now. And I actually have way more cash than I normally would have right now because there really are no amazing deals. Yeah, there's some like fair deals, but nothing that's like where the risk reward looks amazing because the QQQ is pretty much at all-time highs. The S&P is pretty much at all-time highs right now. So the only stocks that are kind of attractive right now are some more of the defensive sector names, like a Progressive insurance company, maybe a Southern company utility, something like that. So next up, I see, and sorry I'm behind on the chat. I am definitely behind here. What is this one right here? So RGTI, actually, we're not really going to cover this one. Actually, the thing with RGTI is it's hard to trust. And like, just to keep it real with y'all, if you look at the market cap, they're a $7.7 billion company. I can, at Micron, I can use their financials and get to like a market cap valuation, but not with RGTI. I mean, they literally did $4 million of revenue this quarter, $1 million last quarter, $1 million the previous quarter. So they do a couple million of revenue a quarter and lose $25 million net income a quarter. So I personally can't get to $7.7 billion valuation, but the stock will probably continue to do good because all of Quantum is on this momentum streak right now. So, yeah, hey, so we're going to do MVO, then we'll do SoFi. All right, I know I'm behind, but we're definitely going to get to all these. We'll look at ADPT, Palantir, PGY, all these. So here's MVO, Oil Trust. Yeah, another one that it's just hard to trust these super small market caps. Yeah, if you look at the top right, they're worth $18 million. I mean, if we all pitch in $1, maybe we can buy the whole company. But, these are not the kind of stocks you want to buy. I mean, look at the revenue this quarter. Like, there's a reason this company is only worth, $18 million. The revenue was literally $1.8 million, down 38% year over year. And on this $1.8 million revenue, they lost, or wait, did they actually make money on that? That's weird. It says, so maybe this is like a royalty stream company. They're not headquartered. It doesn't even say where they're headquartered. So MV Trust is a stationary trust. created to acquire and hold the net profits of interest. Anyway, whatever their stream is, it has dried up, only 1.8 mil of revenue. So definitely one you'd want to be cautious with. It says it has a 50% dividend yield. Might be a dividend trap. I don't know. So SoFi, and then we'll get to PGY and ADPT and Palantir. So this is SoFi Technologies. I'll be quick with this one because we already analyzed this one, but SoFi is a phenomenal fintech growth stock. They're a brokerage. They're getting into like crypto as well. The reason the stock is down so bad right now, though, is because Bitcoin is down so bad. If you just pull up the price of Bitcoin, Bitcoin has basically underperformed most traditional assets the past 5 years. It's nearly where it was at 5 years ago. So, and from 1 year ago exactly, Bitcoin's down 45%, and so SoFi's stock looks very similar. Anyway, let's go judge them off their fundamentals because most of the revenue comes from loans and lending. And that's their biggest segment of revenue. In the lending business, it's good to see that their largest segment grew 55% year over year. That is the highest growth rate on the entire screen. Like the growth rate is growing on SoFi's lending business. And the other side of the business, their financial services, is also growing like a beast, up 41 after 101 after 114. So that's what you want to see if you're going to diamond hand a growth stock that doesn't pay a dividend. You want to make sure they're growing their revenue very fast every quarter organically, and not just revenue, but you also want to make sure they're making profits and their net income positive. And SoFi checks that box as well. They made 166 million net income this quarter, a record net income, and it's not done there. Analysts project in 2 quarters net income is going to hit 240 million. So you really want to judge this company off next year's EPS and next year's net income. And when we do that on a forward PE, SoFi only trades at 24 times. So that's why I think SoFi is undervalued for the growth that they're experiencing. A 24x forward PE seems cheap to me. In full disclosure, I do own a little bit of SoFi stock, and I even bought another share at $15.50 a couple days ago. I rose my cost basis. I didn't mind. So ADPT. So this is Adaptive Biotechnologies. They've had a nice uptrend the past year for sure, but they are lower than their 2019 IPO. But let's go look at the past couple quarters because they're on my watch list. So there was something that impressed me. So they do minimal residual disease, or MRD, and that's growing very fast. Whoa. So that's probably why I put them on my watch list. That's up 53% year over year. Last quarter grew 54, 51. So very nice growth on those two businesses. And they're beating expectations. So the orange line's what analysts predict. Notice every quarter they beat on revenue and they beat on net income. Notice they still lose net income, but analysts projected them to lose more net income than they actually are losing. So they're beating on revenue. So that's probably why the stock is having a nice little recovery. Maybe by the same time next year, they're going to be consistently net income positive. So yeah, look at how they narrowed their losses, because the same time last year, they were losing a lot more money, but now they're barely losing any money. So if they continue this trend of having this 50% growth in this business and narrowing losses, maybe the same time next year, they're going to be net income positive. But yeah, still not net income positive yet, and still a really small one you probably don't want to trust a lot of money in. But maybe as a very small position, it could be decent. Okay, well, what did I say I get to next? Oh yeah, PGY. Again, I apologize. This chat's kind of scrolled up if I'm missing some of the stocks. Oh yeah, TTWO. Okay, TTWO is next. I saw that one a long time ago. See, I just the chat goes by so fast. So here's Pagaya Technologies. This is a company that helps out fintech companies. Let me go to their website and make sure I got the right company. Yeah. So basically what this company does is they approve more loans, or if you use them, you approve more loans and retain more customers with the Pagaya network, all with no additional credit risk. Like they have a lot of, like SoFi's a customer, US Bank Corp's a customer. They've 43 billion in new credit generated. So anyway, they help out fintech companies. And if we look at a lot of fintech companies right now, like SoFi we just saw was on a massive 50% dip the past year. So is this company. They're also on a massive 50% dip. But here's what's better about this one. They trade at such a low valuation. It's only trading at 8.6 times next year's net income. That's like a commodity multiple, only trading at 8.7 times next year's net income. Here's the net income forecast. Supposed to make 32 mil next quarter, 39 million the quarter after that. And check out these net income growth rates. So yeah, from now on, they're supposed to consistently make like 30 plus million in net income a quarter on average. So that's why this one, like the bottom could be in. Like I don't see it getting much cheaper than an 8.6 forward PE. So that's kind of the thesis behind that one. They're just such a cheap one and they're growing pretty nice. So TTWO, this is Take Two Interactive. So this is the company that owns Rockstar Games and they own, Red Dead Redemption and of course they own GTA 5. And if you don't know, GTA 6 is going to be released later this year and that's like this massive catalyst where as soon as they release this game, that's going to bring them in hundreds of millions and billions of dollars of revenue. But I feel like that might be overly priced into the stock at current valuation. That's the only unfortunate part. And Morningstar is kind of saying the same thing. Morningstar says they're overvalued, while the highly anticipated release of GTA 6 will undoubtedly drive massive revenue spike. The market is pricing in unrealistic long-term growth expectations that ignore the inherently choppy nature of the firm's sporadic major game releases. So I can understand why they're saying that because if we zoom out, the truth is, here's the basic metric net income right here. They have not had a single positive quarter of net income since 2022. So for the past 3 years in a row, every single quarter, all they've done is lose hundreds of millions of dollars in cumulative. Like they've lost like $8 billion in like the past 3 years. So that's the one tough part. They haven't made any profits in an extremely long time, but maybe GTA 6 will flip the script. So that's why it's hard to value this one at a $40 billion company when they still are yet to make any sort of profits, or you know what I mean? They're still far away from profitability. So the forward PE, or basically analysts say they traded 120 times next year's net income, which does start to make them look really expensive. They also own 2K and a bunch of other cool games. But yeah, I didn't mean to be too bearish on that one, Sora. It's still really interesting. I do like NDAQ more. So Paul says S&P Global. This is a great credit rating business. They basically have a shared oligopoly with Moody's. They rate debt. Like if you ever heard of a bond, like AAA rating, triple B plus or whatever. The S&P Global is the one that rates that debt. And they're one of the few people to do it with Moody's and Fitch. Morningstar says they're undervalued. Highly entrenched data-driven benchmarks, robust pricing power, and expanding AI-driven efficiencies will drive long-term value growth. They're only trading at a 25 forward PE or 25 times next year's net income. Their credit rating business is their largest segment. That's up 13% year over year. They're also in market intelligence. So this brokerage I'm on right now, Moomoo, this app I'm on, pays S&P Global for the data. So like you see these orange lines we always look at, the analyst projections. If we click on information there, this data is sourced from S&P Global with forecasts provided from 7 analysts. Well, anyway, there's only 7 S&P Global analysts covering S&P Global. That's funny. But anyway, Moomoo pays S&P Global, these brokerages pay S&P Global for their data. But anyway, their credit rating businesses is really good. If we just go to net income every quarter, it's just a company you can trust. They just made record net income this quarter, 1.5 billion before. That's the highest it's been like basically ever. So very nice net income. They pay a dividend too. You buy the shares today, you basically get 1% of your money back in a qualified dividend every year. And at a 25 forward PE, they're at a fair valuation. I do think that. So, YouTube agent said, wait, oh yes, AXTI, or wait, let me get to SNEX, then we'll do AXTI. Sorry, I'm a little behind here. What's up? We'll look at BCSF. What's up, Looney Zone? Shout out to member Looney Zone and Wi-Fi. What's up, y'all? And OSnap. What's up, everyone? So here's Stone X right here. I've never heard of this one, Stone X. I wonder if this is like a construction company. Whatever it is, it's at an insane all-time high today. So if you've ever owned this one, you're definitely up on your money. So they do commercial. I like that. So it's not like residential, but what is it though? Capital markets? Global payments and securities, listed derivatives, explore the derivatives, securities, foreign exchange, OTC derivatives. So some sort of like market maker, capital market company. Oh, but it's so look at this. The US is only 5% of the revenue. So it's like an exchange, but international because 91% of the revenue comes from the Middle East and Asia. So it's like an international NASDAQ, maybe something like that. I don't know. And so this is in US dollars though. So we're looking in USD. They do make really good net income. This quarter they made 174 million and that's real. That's real after tax net income they made. So Very interesting here. Their net margin is a 0.38%, but that still makes them a lot of net income. That net income beat expectations. Analysts expected 121, they did 174. So no wonder the stock is at an all-time high. And even though the stock is at an all-time high, they're only trading at 22 forward PE. That means to me this stock is going higher and like a lot higher. That's not a peak valuation. Peak valuation maybe could be like a 30 or a 28. So there's still potentially a lot of upside. If you own that one, I would not trim or sell that one. So let's do AXTI. Then we'll do Data. Oh, Palantir. I so forgot about Palantir. Palantir's next because I was supposed to get to Palantir like 20 minutes ago. Sorry. So here's AXTI. They mine the gallium and the like rare earth metals that are used in semiconductor systems, the substrates. So yeah, look at this, substrates, raw materials. That is all of their revenue. And I'll go to their investor their presentation and show you the actual metal because I forget what it is. Something like cool sounding. Yeah, there they go. They sell indium phosphide and gallium arsenide that's used, supplying 8-inch gallium arsenide to wafers, to major wafer customers. So gallium arsenide markets. So anyway, the key applications are in power amplifiers, LED. Anyway, they are finally getting net income positive. So if we go to the current net income, as we can see, they have not made any net income like ever. But they barely lost any money this quarter, only 1.5 million. But if we go to the forecast, they're supposed to make 3 million of net income next quarter and 5.5 million the quarter after. So you're basically buying this stock as they're getting net income positive for the first time ever. But at a 301 forward PE and a 7.5 billion market cap, I don't get there off today's numbers where the risk reward buying today looks extremely hard. Like I would not buy today, especially after this 18% rally. But I would, if you're really interested in the stock, I would look up the actual price of like gallium arsenide or whatever those precious metals were. And I wonder if their stock follows the actual commodity price because I know a lot of rare earth metals are having a lot of inflation, like aluminum and copper and gold. All right, what was this? Oh yeah, Palantir I said I get to. Yeah, Palantir, this is a phenomenal growth company. I would wish to own Palantir, but I would need them at a cheaper valuation. But check this out right here. This is what's so impressive. Half of Palantir's revenue comes from the government. So many police stations, the Air Force, the military use Palantir. And this business grew 76% year over year. That's the highest growth rate on the screen. That's an insanely fast growth rate. And not just the government revenue grew 76%, but the other half of the business, commercial side, grew 95% year over year. There's a reason Palantir is so hyped and loved and has such a high multiple. That's because they really grow faster than any other company and they beat expectations every quarter. So the orange line is the net income projection. And the blue line is what they actually report. Notice they beat on net income every quarter by a good chunk. Look at the margin expansion. Net margin went from a 24 to a 53. So for every $100 that comes in, they keep $53 after tax. They're basically collecting royalties. Revenue's up 84. And cherry on top is they literally have no debt. This is a literal, by definition, fortress balance sheet. No debt at all. $8 billion of cash, just chilling there earning interest. The only bad part is about Palantir is the fact that the market loves them so much that they've ran them up to an 87 forward PE. It's too expensive for me to pay, but one day I'd love to own them because they really do have good fundamentals. So OSnap said DVLT, and yo, congratulations to YouTube Agent. He says I'm almost at 50K in my portfolio, dude. Huge congratulations, man. That's awesome. Nice milestone there. Or once you hit it. I know you'll hit that soon. So here's Datavault AI. Actually, we won't really cover this company. If you look in the top right, they're only worth $346 million. I mean, this is a micro cap at this point, and they're at an all-time low. But let's see. So the whole company is worth $340 million. Here's the thing. Just imagine this in the back of your head. You buy the whole company for $340 million. You're buying a company that just lost $53 million, which boom, that's over like 18% of the whole market cap. And the quarter before, 10 million, 6 million, 5 million, 42 million. So it's a tough sell for me. I mean, the revenue did grow, but it's easy to grow when your revenue is so tiny. So the revenue is only 3.4 million. So that is why I suspect this company is only worth $300 million. But Yeah, I would not trust anything meaningful into this company right here. Yikes, big money loser, very small revenue. All right, we'll look at a few more here, then I gotta run. Ooh, George says BWXT. Oh my gosh, this is the company that makes submarine naval nuclear reactors for the government, and they make commercial nuclear reactors. This is fascinating. I'll show you their website right here. So yeah, the government is like 60% of the revenue. But yeah, naval nuclear propulsion systems or naval nuclear reactors, they've made over 400 of these. We have proudly manufactured naval nuclear components and reactors since 1950. And also, they sell these nuclear reactors to commercial companies. So, nuclear steam generators, we are, if you didn't know, nuclear reactors really just are steam. The uranium just heats up water into steam and then it turns into a steam turbine. Anyway, complex site operations, 13 high consequence sites managed for U.S. government. We are making significant contribution. Anyway, they're also not just, big in nuclear, they're a money printer. They have good financials. So if we go to net income right here and zoom out, if we average it out, they're the most profitable like they've ever been consistently. They're making like 90 million of net income a quarter. How about free cash flow? Yeah, free cash flow is even better. They have over 10% net margins. And look at the net income forecast. Net income in 2 quarters is going to hit 111 million. It has never, ever been close to 111 million in net income before. So there's still a lot of EPS and net income growth still to come to BWXT. Yeah, government is 67% of the revenue, and the commercial is 32%. So yeah, that's BWXT. Pretty cool company there. All right. SoFi is not an interest rate risk unless they suddenly soar. They're mostly consumer short-term debt. Yeah. All right. What's hmm. Would brag about holding Palantir. I did lose 100 shares of $40 because I sold an option. Well, y'all want to see the biggest L about Palantir? I sold Palantir. Uh-oh. Oh, well, it doesn't even matter. I got to click off the restriction before I fill out the CAPTCHA. Okay. Yeah. Check this out. If we go to Palantir, this is sad. I sold all my Palantir at $8.29 a share. I bought it at $7.45, sold it at $8.30. If I still held it, I'd be up like 1,300% on Palantir. So my biggest regrets in the market has actually been selling out of high quality companies. Same with like Robinhood as well. Check out Robinhood. I sold 58 shares at $36 a share. And Robinhood is $99 a share. I would have been up way, way, way more if only I held those shares. So that's actually why I made this Moomoo portfolio here. If you look in the top left, it's called my buy and never sell portfolio. So once I buy a stock in here, I legit never sell it. Yeah, these are all the stocks I hold forever, basically. Amazon, Coca-Cola Consolidated, Amphenol, Comfort Systems. So someone said JP Morgan. Yeah, we'll look at JP Morgan, then I'll head out of here. Thanks again for showing up to the stream. If you haven't already, please leave a like. And if you do enjoy, consider hitting the subscribe button. I sell nothing. I have no course, book. I literally sell nothing. So here's JP Morgan. It's a great dividend growth company. If you buy a share of JP Morgan right now, you still get 1.9% of your money back every year in a qualified dividend. And they raise the dividend every year very fast. So basically, you're basically getting 2% of your money back every year in a dividend with JP Morgan. And the valuation is fair for a bank. Even at today's price, they're only trading at 14.5 times next year's net income. And here's the net income they make. JP Morgan genuinely just prints money, easily making like 13 to 15 billion of just net income every single quarter. And then they return some of that money to you via a dividend. They pay out 28% of their net income in dividends. They also do share buybacks and they do M&A and invest in the future. JP Morgan reports 1.73% credit card charge-off rate, 0.8% delinquency rate in May. JP Morgan says U.S. consumer is resilient, but monitoring inflation impact. Expects 2026 loan growth above industry average. What is this? JP Morgan and major U.S. banks face congressional AI cybersecurity inquiry and DOJ subpoenas on alleged debanking practices. Huh. Anywho, that's something that's interesting. All right. If the Iran deal holds and lower oil rates holds or falls, further rates should hold. That's what can send the market up to all-time highs. If we go to markets predictions, like literal right now, the market is pricing in for interest rate in the October meeting. There's actually a 40% chance of an interest rate hike. So the market is literally pricing in 40% chance of a hike of rates later this year. If we get worse come out this week and say, hey, we're not actually going to hike rates at all, we're just going to stay flat, the market would go to all-time highs. Oh yeah, here's a bunch of watch lists. They have all these like different sectors. One stream, I just want to go through all of these and like find new stocks that are interesting here and a bunch of cool industries that could be cool. Save a bunch of industries here. I have spare 5K. Should I add more Amazon or Taiwan Semi and plan to hold forever? Yeah, especially if you have a long-term horizon, buying and holding both of those would be great. I would, of course, be more diversified. I don't know your whole portfolio and what other stocks you're doing, but yeah, I'd keep the majority of my portfolio in a safe like S&P 500 index. You don't want to go all in on just two stocks, But yeah, Amazon is one that you can just sleep well at night with, and same with Taiwan Semiconductor. Always a great stream, favorite. It's like, hey, yo, thanks, Matt. I appreciate you, brother. So yeah, that was the stream. I hope you guys have a great rest of your, what's today? Monday? Yeah, I hope you have a great rest of your Monday. Let me end this with a stock portfolio update. Then I'll get out of here and hit the follow button and like button if you haven't already. I'm going to try and stream like every day, every other day. So this is my dividend only portfolio. I love being fully transparent. I go to a bunch of other streams. No one shares their lifetime returns, how much their lifetime percent up and down on every stock, what they're buying recently, and they're always selling something. I'm just going to give my opinion. That's not financial advice. So over the past year, my Robinhood account is up 18%, which does underperform the S&P 500. But yeah, just today we're up 2.6%. And here's my lifetime percent change on every stock. Google's been our best performer. We're up 130% on them. And here's our total equity in every stock. So our smaller holdings are at the bottom, largest holdings are at the top. We also have a Roth IRA. We started this just over a year ago, exactly. And all time, we're barely break even, or we're down 0.01% since we started this. So yeah, these are the 4 stocks we own in here. I kind of try to keep it simple. I got 4 stocks in here. I got 7 stocks in here. And then we also have 6 stocks in this movement portfolio that I've kind of been showing already this whole stream. But yeah, I got 6 stocks in here: Comfort Systems, Powell, Amazon, Coca-Cola Consolidated, Amphenol, and Moog. And year to date, this is what's really led us to outperform the market. Just since January 1st, this portfolio is up 77%. Versus the S&P 500 up 10%. And if we go to our return from 1 year ago exactly, we're up 167%. Pretty ridiculous. And we're up 35 grand all time in here. And then finally, we have our Webull portfolio. And I'll let y'all know as soon as I buy something, because right now I'm chilling on $900 of cash in here and another $500 of cash in my bank ready to deploy. But right now, you just got to be disciplined because there really isn't too many good deals. Like there's some fair deals, like there's some all right deals, especially on like the defensive sectors like Progressive and like AbbVie right now. But the deals that we want, the growthy tech multi-baggers, the risk to reward on these do not look too good right now. So I think it's good to just hold on to cash right now, even though I normally like to spend all my cash as soon as I have it. Having a little bit of cash right now, a little bit extra dry powder than normal, I think is a benefit right now. So yeah, we're up 3.75% on the day. In all time, we're up 32% in here. AMD has been a great performer today. Dave is close to an all-time high. It's really software that's jumping today. Reddit's up 10, Futu's up 4, Uber 6, AppLovin 5, Robinhood 6, Microsoft 2, Ouster 13, SoFi 4. And then what's down on the day is the defensive stuff like the AbbVie, the Sprouts Farmers Market, the Progressive. Well, actually, Progressive slightly up. So anyway, that was the stream. Thanks again. Hope you guys, by the way, any Discord server, 3rd time I've been here. Actually, I do technically have a Discord server. I don't like to promote it, but to join my Discord, it costs $1 to join. It's technically in the description. So you could just go to the description and pay $1 to join. Or if you become a YouTube member, you get permanent access to the Discord. So even if you like become a member for 1 month and cancel the next month, you still get permanent access to the Discord for a lifetime. I made it $1 to join because I don't want any bots in there ever. So if you just have a question or you need help analyzing a stock or want to see what my most recent purchases are or have any questions for me, you can join the Discord. But again, I that's the only thing I technically sell. I sell nothing else, but I made it literally $1, the lowest amount possible. Link in the YouTube description. Anyway, thanks again for showing up. I will see y'all soon. Hit the like button if you haven't already. We'll be streaming tomorrow, and I'm going to try and make a video later this week. Thanks again.